take it slow. I have other family members that were devastated, but I knew that I could do it because there were other traders in the community that I was a part of that were making it happen, that were growing these tiny accounts into millions of dollars. So I think by the beginning of 2018, I funded another account, this time with about $5,000. Probably 6 months in, I ended up blowing that account as well.
Oh, wow.
I was, yeah, I was just longing breakouts, and that wasn't working for me.
I see. So were you choosing the same strategy the second time around as you did the first time around, or did anything change?
It was the same strategy. Nothing changed. I hadn't even looked into short selling yet because I was too intimidated at first from the short side of things. I didn't understand the concept of shorting yet. And I also didn't understand how you have to locate shares and how you can owe the broker money and things like that. So it scared me away from it initially.
So what did you learn? What was your kind of key takeaways from going long breakouts that ended up blowing up your account? What did you learn from that?
I learned that I shouldn't be doing that.
Well, why is
no,
that?
I yeah, I didn't find an edge in going long for me, and still till this day, I haven't found my edge in going long.
Hmm.
Uh, I found my edge in strictly. I'm currently 100% short seller. I'm short biased. All I do is just I short these parabolic moves.
What kind of stocks were you originally going long on the breakouts? NYSE, Nasdaq, or
No, it would be OTCs and pink sheets.
oh, so you started off with the pink sheets.
Started off with the pink sheets
Hmm.
because there's a guy, Tim Grittani. I'm not sure if you've heard of him. He trades. He traded OTCs, and that was a large part of his come up to make $1 million. So I thought that I would do the same thing, but I learned fast that in this game, everyone's edge is sort of different. It can rhyme, but it doesn't oftentimes repeat.
What does that mean, like when you actually place trades, looking back on this during this time, when you say it could often rhyme, but it doesn't repeat?
Yeah. So, for instance, I know the mentor that I was looking up to. He would cut his loss very, very quick, and it'd be like a stock sets a top at 210. At 211, he would cut his loss if he's shorting the stock.
Mhm.
Okay. Me, I have to leave room for what I call the blow off top. So if the stock sets that same top at 210, I would set my stop loss at about 231, 233, something odd, so that it gives me room just in case the stock does a liquidity grab where it'll spike up quickly and then drop. Oftentimes I would get caught in those moves where I would have the right idea, but my stop loss would be too tight.
From my limited knowledge of OTC stocks, they frequently can have a very wide bid-ask spread. What was that not the case with the stocks that you traded?
That was, yeah.
Hmm.
And like I said, I only traded the OTCs on the long side. I haven't dabbled in shorting of the OTCs.
Uh-huh.
I switched over to Nasdaq's once I started short selling.
I see. So speaking of OTCs, I noticed on the OTCmarkets.com that there are over 17,000 OTC stocks available. And in the stock screener, if I select the caveat emptor button, which in Latin translates to buyer beware, the list of stocks, the list of 17,000 stocks now only shows 848. So with, what is that, about 95% of the stocks falling into the buyer beware category. How does one go about choosing which ones to trade?
So, what I was taught was that on the daily chart of the stock, if the stock is breaking out over a new multi year or multi month multi-week high, you would buy that and you would ride it couple cents, couple percentage upwards, and then take your profits. But you don't invest in those pennies in those OTCs, obviously for the reason that you mentioned.
Hmm.
Um, those they're scammy companies. They're not really good companies to invest in.
So essentially you're just day trading?
Essentially, you're just day trading them. Yeah, you never want to get married to any one stock, especially not an OTC. I made the mistake early on. There was a Shark Tank episode, and I forget the ticker. It was BCC something, BCCI maybe. OTC. I tell my family about it. And I'm like, this thing was on Shark Tank. Uh, it's going to go to the moon. We should all get shares of it. And I think it wasn't until probably 2022 that I opened up my E-Trade account and I was like, I still have shares of that BCCI. And
Uh-huh.
it did absolutely nothing. I didn't make any money off of it or anything like that.
Is there enough liquidity to trade these stocks? I mean, what can you describe what's your screening process, or are you getting fed ideas from your trading group?
No, so the screening process that I have, do you mean for the OTCs or for NASDAQs now?
Well, yeah, actually, let's cover both. First, OTCs, and then let's go to NASDAQ.
Yeah, for OTCs, what I would screen for, it would have to at least have a million in volume shares traded. I would have traded any price of the OTC. So, I mean, it can be 0.003
Hmm.
and I would still be looking to long it at that point in time. Now my criteria has changed a bit. What I'm looking for now, what I put in on a scanner is I would like it to be at least 10 cents. It can be any price above 10 cents, but I would like it to be 10 cents. I would like it to have at least a million shares traded in volume, and then I would like it to have at least 100 trades, 100 different trades. And that is my go-to criteria for finding these, parabolic runners or gappers that I intend on shorting.
How long did you trade OTC stocks from the long side before switching to the short side?
Probably my first full year of trading. And then into 2021 is whenever I switched over to the short side.
So the short side, so you shorted OTC stocks and the NASDAQ, or how did the NASDAQ, how did you get involved with NASDAQ stocks?
Yeah, so I just short the listed, the Nasdaq stocks. I don't short OTC stocks.
Uh-huh.
I migrated away from OTCs. There's a trader by the name of Stephen Ducks. This guy, he's an amazing trader, and I watch a lot of his material that he trades listed. He doesn't really trade OTCs. So I migrated to the Nasdaq exchange, and that's whenever I really found success.
So what makes you want to only go short? What were the catalysts to just choose that?
So that's really just where I found my edge. I would love to become the jack of all trades, where I can short, you know, I can short the parabolic, I can dip buy, and then I can short the bounce and ride out the long kiss goodnight or the fade. I would love to be the jack of all trades, but right now I've just found my edge in short selling. So my thought process behind that is I'm going to continue to focus on these one or two strategies that I have and on that are short biased, make probably my first million doing that, and then I will begin to introduce new strategies for the long side.
Can you share with us the factors that you look at when selecting stocks to short?
Yeah. So whenever I'm looking for my go-to play is called the short into resistance. Now, this can happen whenever a stock is gapping up on the day. or it can be the first green day or a multi-day runner. I'm looking for a stock that is spiking into a previous day's high. So let's say back in January, a stock set a top of $2.50. Then it dies down, goes down probably to 50 cents. In May now, when the stock is back on the scanner and it is having trading volume, I'm looking for it to spike back towards that $2.50. And once it gets close enough to that $2.50, I would like for it to have a hard crack. Then I would short the bounce on that hard crack, risking that $2.50 level.
I see. So you're shorting it kind of on the third round that it pops up. I mean, like the
Right.
third bounce on the chart. Is that accurate?
Yes. Yes.
Okay. Okay. I see. And what other factors do you look at? Do you look at is short interest or how much you have to pay to borrow the stock? Does that factor in as well? Or
So locates, they do factor in. Some of the low float stocks, the micro flow stocks, are very expensive, depending on where you're at. If a stock is too expensive, I'll leave it alone. I might avoid it. It goes on my avoid list. But for the most part, whenever I am shorting a stock, I'm just looking for it to have the liquidity on the day, so the volume that I mentioned earlier. And then if it's a short into resistance, I'm looking for it to be going into that resistance.
is your edge just being patient to wait to find those stocks that happen to fit that criteria? So like on the third bounce and it hasn't broken above the previous resistance. Is that your edge or is there something else?
I would definitely say my edge is in the ability to not have to trade every single day.
Uh-huh.
So the short into resistance, it doesn't always come. But whenever it does come, I am ready for it. I am prepared. I trade like a sniper. I'm in and I'm out.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
The other short setup that I'm looking for is called the front side short. I like a stock to be extended either on the first green day or a multi-day runner, extended at least 300%.
I see extended 300%. So what does that mean? Like, give us an example.
So that would mean that from the stock's previous close, it has pushed 300% upward. And I would like to short into that strength.
I see. To short into that strength. So say the stock is at, we'll just say it's been at $10 for a long time, and then you say it spikes 300%. So that would take it from $10 to $40, right?
Right.
And then what are you looking for then?
Then I'm looking for a hard crack,
Okay.
for the stock to for the stock to get an immense amount of volume and then have a hard crack, right? And hard crack is, it's a subjective term, but I would like it to, um, at least on the chart, to look like it's a massive crack on the chart. And then I would like for the stock then to bounce up, and I would short into that, risking the high of day that it just set.
So how long do you typically have to wait before you see a setup like this that you like and you jump right in?
They usually come very often. It depends on the market.
Mhm.
We're in a cycle right now, with the meme stocks and the liquidity that's come from those guys, where these stocks are going 250, 300, 500%, things like that. FFIE, I think it
Mhm.
went 3,000 something percent. And so these are the stocks that get me licking my chops. I'm chomping at the bit to try and short these stocks that are extremely overextended.
So are there any examples of any meme stocks that you've gotten into in the last number of years?
I actually played GME, GameStop, and AMC. I want to say it was, I'm not sure exactly what day it was, but it was the day when Roaring Kitty, uh,
Hmm.
he was tweeting different memes, and the stock was just reacting to it, and it went parabolic. I think it got up to 65 or 80 pre-market or something like that.
Are you saying just in the last a couple weeks, or are you talking about like 3 years ago?
I'm talking about in the last couple weeks. Yeah,
Oh,
sorry.
yes. Okay. Uh-huh.
Yeah, I so a couple years ago, backtrack a bit. A couple years ago in 2020, I missed that entire meme run. I know that's when a lot of people became millionaires during that 2020 COVID market. Um, I wasn't trading then, but I was able to capture the move that it did on the 14th of May, and I was able to make a good profit gain off of that.
Uh-huh. Just from the short side and just intraday?
Yes, just on the short side and just intraday.
Do you only day trade? Do you ever hold positions overnight?
Sometimes I do,
Mhm.
but it's rare. There's only one setup that, for me, warrants me to hold overnight, and we call it the Doji Day One. And
Mhm.
basically, it's a large gapper that has failed on the day, and it gaps up, let's say, 200% from its previous close, and then it falls beneath the open. So it's a red candle on the daily chart. And I look for a bounce to get in, and I will swing that into the next morning looking for a gap down.
So since the majority of your trades are intraday, I guess in that case you don't really care about the existing short interest or the how much you have to pay to borrow the shares. Is that accurate?
Yeah, that's accurate. Not
Mm.
too much. The fundamental aspect of it, it doesn't really play a factor for me. Now I say that, but I do have dilution tracker where I can see the offering ability of a stock, and if they do have potential toxic dilution coming up or anything like that, it might give me a bias to hold longer.
So do you know? I mean, I don't short sell that much, but often I hear the longs screaming about, oh, this is going to be a massive short squeeze and the shorts have to cover. Do you know of any service or have you heard where one can find out the average price that the shares had been shorted at, because I was thinking that just because it has a high short interest, the shorts could cover on one day, but then new shorts could come in at higher levels that have deeper pockets. And so, how much do we really need to fear from a short squeeze?
I haven't found any service that does that, but these short squeezes. I'm sure you've heard of the saying, the market can stay irrational longer than we can stay solvent. I think that talks to short sellers, over aggressive short sellers.
Right. Right.
Yeah, you never really know how high something can go. I've been in a stock where I've I decided to take my stop loss out, and I was like, you know what, I'm not going to cover. It's bound to come down. And it turns out I shorted the black swan of the day.
Oh, wow. Wow. Congratulations. Uh,
Yeah.
one other short seller I talked with said that he signs up for these alerts from the companies, and like where they're going to try to hype the stock to pump it up,
Mhm.
and then he uses these alerts that he gets to his email box or his messenger to the tool to know when the big push or the big hype is on, so that he can select the appropriate stocks to short. Have you ever heard of something like that?
Yeah. So I've heard of promoters
Hmm.
and these promotion groups of penny stock promoters, usually that will hype these stocks on Twitter or in their chat forum, whatever it may have you. And they're trying to get people to buy the stock and purchase it to make it go higher and higher, and then they're going to dump their shares into that liquidity. It's not something that I don't think anyone should make good practice of. But the way that guy in the example that you just gave uses it is a very smart tactic.
Yeah. So, what are the qualities of a stock that you look for that would encourage you to hold overnight or even possibly days, weeks?
I would have to say extension. The stock has to be extended. The golden number for me is that sweet 300%.
Hmm.
Uh, if we get a 300% gainer, that's when I'm looking to short it, and I'm looking to hold it for as long as I can. Usually, I take my profits early. I trade sometimes like a chicken, like a coward,
Hmm.
and I don't want to take unnecessary risk. So I personally would love to learn uh, swing trading strategy. There's a great long biased swing trader, Jack Kellogg.
Hmm.
That Jack he's awesome, man. He's the jack of all trades, we'll call it, and I aspire to sort of trade like him in the future. He's able to go short, go long. It doesn't matter. Swing trade, day trade. It's amazing.
Yeah. Yeah. I actually interviewed Jack a few years ago.
Oh, okay, that's awesome.
Yeah. Um, so, getting back to so in other words, how often do you see these? You said frequently. How often do you see these plays where you get that 300% movement up, the ideal type candidate? Is it rare? I mean, do you find yourself being kind of impatient, sort of like itching to get on the next trade? And how are you able to keep your discipline?
Yeah. So being a football player, we were taught and bred discipline from a young age. I played football since I was in the third grade.
Mhm.
So it does take discipline. There's a lot of quirks about trading that are synonymous with sports and professionalism and things of that nature. So you just have to really put it in your mind that if my setup does not present itself, I am not going to initiate a trade. It doesn't matter. The stock, for me, I don't trade gappers. A lot of people do trade gappers. And what I mean by a gapper is a stock that's just up 150% or 100%. Um, a lot of short sellers will short that. I leave those ones alone and I wait for it to extend 300%.
Oh.
So,
Hmm.
yeah. So, a lot of times I'll miss out on a trade. And I'm okay with that because my strategy and my edge says that if it's a gapper, it needs to reach at least 300%. And then I can take advantage of that extension and try to ride that down.
And so there's plenty enough stocks listed on the NASDAQ that have these kind of gains periodically. So you're not just impatiently waiting weeks or months before you get that kind of juicy setup.
Yes, yeah, there is. In short, I I'll probably see a 250, 300% gainer at least once a week, maybe once every 2 weeks.
Okay.
Um, Other than that, if I'm not trading the front side short, then I'll be trading the short into resistance, and that comes about I'd probably say twice a week, 3 times a week.
Now you mentioned about the quality of the bounce back up. You got at least two bounces up before that you short on the third attempt up. And you mentioned spiking. What happens if the stock just trickles up on low volume in a slow way? Does that change either, say, even your position size or change whether you're going to get in and short it?
Great question. Yeah, so if the stock is just slowly trickling up, I'm more times than not waiting for it to go parabolic. I often I can't remember the last time I traded something that was just trickling up slowly and slowly and kept going up. Uh, Usually they will trickle and then they'll have that parabolic push upward. And the first time it cracks and bounces off of that crack, that's whenever I'm looking to get in. So oftentimes the ones that just crack and fade out of the gate at market open,
Mm-hmm.
I'll miss those because for me, I like to short strength. I don't really short weakness.
And you mentioned about volume. Do you look at indicators like RSI or any other indicator to help you determine the quality of the bounce?
So the only indicator that I use personally is VWAP, volume weighted average price. And I think, a lot of these other indicators, they can overcomplicate things in my opinion. If a stock spikes up and then it has a hard crack, has a bounce, I get in and it's starting to fade down, I would cover my position partially or in full to take profits, right, as it fades. And then I would use VWAP as an indicator. If it can bounce to VWAP, I will reshort it, looking for it to reject off of VWAP and fade back down.
And what are your risk management techniques?
I was taught that having a consistent risk is like the holy grail, and in my opinion, it is to have a consistent risk at a max daily loss at the broker level. I think is very helpful and useful for any trader to have. It acts like a seatbelt. So let's say my consistent risk is $2,000 on the day. If I hit that $2,000, my broker will come in and they'll be like, "Hey, no more trading," um, and I won't be able to place a trade anymore on that day.
Now, is this something that you set up through your broker? You program you program the seatbelt for yourself?
Yeah, so you can just email your broker. Most brokers, they allow this max daily loss. You can email your
Mhm.
broker and ask them, "Hey, I would like to set a $2,000 max daily loss or $5,000 max daily loss," which that's actually a big one.
Uh-huh.
But um, yeah, at the firm that I'm currently trading at, my max daily loss is $2,000.
I see. So you've been trading by yourself for how many years now?
So by myself, I was trading from 2017 until 2021, 2022.
Mm-hmm.
And I started trading with the online prop firm. I started trading with them probably about a year and a half ago.
Why is
And
that? What made you go the funded capital route?
So growing up, we didn't really have much uh, whenever it comes to access to funds and things like that. So I couldn't keep funding these accounts, but I knew that I was onto something with the trading. So I went the funded capital route because they provided their capital that I could trade with, and then they would get a profit split of the profits that I make.
Mm-hmm.
Yeah. So to really help out with the funding issue of the accounts.
I see. Up until that time, how had you been doing during the first 3-4 years, percentage wise, kind of trading your own account? Were you able to make some money eventually, or was blowing up your account a too common of an event?
It was way too common, man. It was a bloodbath, honestly, for a while. It wasn't until probably this last year and a half that I found consistency, and then I was able to really go parabolic in my P&L chart.
Why is that? I mean, were you still during all these years, were you still trading from the short side in the way that you've described to us?
It wasn't until I watched a DVD called Trading Tickers 2. And in that DVD is where I learned the setups that I explained to you, the front side short, the short into resistance, and the doji day one. And then I was watching somebody online, I forget who it was, but they basically were like, for your first 100,000 or even your first million, just focus on one setup, one or two setups, right? And so in my head, I was like, okay, I've been trying to be the jack of all trades and it's not working currently. So let me go ahead and narrow my focus to short into resistance, front side short, and that's it. Let
Mm-hmm.
me go ahead and work on my discipline to where if those setups do not present themselves, then I am not taking a trade.
Uh-huh. I see. And you adopted this right around the time that you started with the funding prop firm?
Yes. Yeah. I
Mhm.
spent the time before that, I spent just studying this trading tickers too. Uh, I talked with other millionaire traders, Andrew Yang, he goes by Quick Bags on Twitter, and Mike Huddy. They've been instrumental in my trading career. And then I've got a trading accountability partner, Arbner and Christian. They really helped me with the discipline of it all. We hold each other accountable. Every single morning we trade in a group chat. So the play will come up and they know my strategy. They know what trades I am willing to take and not take. So if I take something outside of my strategy, I have that reinforcement from them like, hey, you're not supposed to be trading that. And then I can exit the trade.
I see. So you hold each other accountable, and that way you strengthen each other and help each other overcome their impulsive weaknesses.
100%. Yeah, there's parts of myself that I might not be able to see or recognize as a trader, but having those two guys as partners and as friends, they can cover my blind spots, if you will.
Is that one of the key advantages of going through a funded capital route because of the other players in that group?
That is, yeah, I would say that's probably the biggest advantage other than not risking your own capital.
Hmm.
Um, Having a community, having a group of people that can watch your back for you. Trading it's very tough and honestly it's very lonely. So to have those guys that can call me on my BS, if you will, if I'm trying to be delusional with myself and I'm like, you know what, this might be a trade actually. We've all been there.
Yeah.
But in the pit of your stomach that you're really taking a trade that's outside of your strategy. But to have somebody call you out on it is just a different level of like discipline that it instills.
How is the psychological aspect of trading with other people's money versus just trading with your own money?
That's a great question as well. So, the biggest thing that I've noticed in the beginning, it can feel like it's not real when you're trading with other people's money. It wasn't until I got my first withdrawal, my first payout, that I was like, whoa, this money actually translates to real world tangible things. That's whenever I started treating trading like a business, treating it like, I always try to like envision that I'm like a Navy SEAL or like a sniper going in on a mission, go in, come out, very quick, like, but very disciplined as well.
Wow. So what was your performance like prior to going the funded capital route, and how did it change once you did get funded?
Yeah. So I want to say I was down about $60,000 going the non-funded route.
Hmm.
I wasn't finding much success. And at the same time, though, I attribute that to not taking trading fully serious. It took me some time to really treat it like a business, like I was saying earlier, and just adopt the mindset. The psychological aspect of it is so powerful, and it's so important whenever it comes to trading. But yeah, once I started trading for the firm, since the beginning of this year, actually, I've made close to $300,000.
Wow. What does that translate to in a percentage return?
So I had 260,000 in buying power
Hmm.
to be able to generate uh, gains from that and generate profit from that.
That's a fantastic return. Uh, how do you emotionally detach yourself from the amount that you're winning or losing to kind of keep your cool?
For me, it has to sort of be, and I hate to say this, but you have to gamify it a little bit
Oh yeah, what's that?
in this, and gamify in the sense of that trading becomes a game and you're wanting to reach the high scores, right? You're wanting to reach the next level. So if you view it like that and you detach from like, wow, man, I just lost $5,000. That could be a payment on a car or something like that, or on a house. To I just lost $5,000, but that's all in perspective to my overall account, if you will,
Hmm.
or to how much I can gain on the day, if you will.
Hmm.
Um, so I think gamifying it for me, it helps to keep everything in perspective. I'm in it to be one of the best traders in the game. That's what I want to do.
So, with your ability to trade penny stocks or these kind of small cap Nasdaq stocks, uh, do you feel these skills can be translated to trade any kind of type of market? And do you want to expand?
I would love to expand. I just personally, I don't even know where to begin to to try and expand to like large caps or blue chip stocks. It's just the small caps have so much volatility, that you can capture, if you can capture these 60% moves, things like that, and it's just I wouldn't know, but it doesn't seem like you can do that on Tesla, right? Like
Oh yeah,
capture a
right.
60% move in one day. It's unheard of.
So even during the time, say the last year and a half, where we've had periods of low market volatility after coming off the frenzy, in 2020 and 2021, there's still plenty there to keep you busy and
Yeah,
for you to keep cranking in profits. So you don't really need to trade other markets, right?
100%. Yeah, and
Hmm.
I think that's the key right there. Is like I'm I'm sort of content right now trading small caps, and I'm also honestly content just going short on these small caps. Um, but I know that it's only going short is only one side of the coin. Going long is the other side. And
Mhm.
so if I can find a profitable long strategy, I can potentially, in theory, double the amount of money that I can make. So it's something that I'm looking into actively.
How does your family, who treats this as gambling, have you shared with them your your successes?
Yeah. My brother, I shared it with my brother, and he was like, pull out. It's time to pull out. I was like, it doesn't really work like that. He's just thinking that from a naive mindset, not really understanding the full scope of day trading. But he does it out of love, so I definitely understand.
Uh-huh. Yeah. Have you shared this with any other football players?
Yeah, I've got a buddy, Blaze. Actually, he messaged me on Instagram, and he was just telling me how crazy it is that I'm able to do this. Right, like I was able to compete at the highest level, and then basically fell from the top, I guess you could say, in the NFL, and then started back over and am now competing at the highest level again in a different field. So it's crazy to think about. When you're inside of something, you don't really feel the same pressures or perspective that people from the outside looking in might see.
Right. Yeah, exactly. Well, it sounds like you can be a good inspiration for both your family and your fellow football players, huh?
Yeah, exactly. Yeah, I might even begin teaching one day.
Oh, good.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Good. Do you have any advice for traders?
Yeah, I'd probably say my biggest takeaway that I've learned is to one focus on uh, one or two strategies, hone those strategies, become master of those strategies before trying to become the jack of all trades, and then two, I personally I have a rule called the first 45-minute rule
Uh-huh.
where I would only enter into, and this I don't necessarily abide by this rule anymore.
Hmm.
Now that I've become more advanced in my trading, but whenever I started out trading, I would always adhere to this first 45-minute rule, and basically, in the first 45 minutes of market open is the only time that I can place a trade
Oh, why is that?
because that I for me I noticed that if I was taking trades in the afternoon, initiating trades in the afternoon, I was taking most of my losses.
Hmm.
So I analyzed my trader sync, and I saw the different times at which I'm making money and the different times at which I'm losing money. And I saw that I would make money in the mornings and then I'd give it all back in the afternoon. And this was a repeated thing. So, for the most part, I just cut out the afternoon, traded the most volatile time, which is usually that first hour of the market open. And I could manage a position throughout the day. But after the first 45 minutes, I could not enter into a new trade. And that really expedited my P&L curve and got me profitable.
You're looking to initiate the trade in the first 45 minutes, and does that also mean that you're looking to exit in the first few hours or so?
No, so that's the caveat. You can manage the trade throughout the day as it progresses. So let's say you're shorting a stock in the morning and it's fading all day. It's an all day fader. You can ride that out
Hmm.
and cover into pieces to lock in your gains. I've even held till end of day multiple times and covered then. So, but it's just mainly about the entry.
I see. And VWAP is the indicator that you like to look at.
Yeah, VWAP is the only indicator that I
Uh-huh.
use. Yeah.
Did you ever get into journaling or get a software that does that for you?
Yes, I actually use TraderSync currently. It showed me a lot. It showed me that my win rate is roughly 49%, that I'm most successful and most profitable on stocks under $5, things of that nature.
I see. So, well, great. So to wrap things up, what do you struggle with most as a trader?
I would probably say what I struggle with most as a trader would be sitting on my hands whenever my setup is not presenting itself, because my criteria is so strict. Um, but when my criteria doesn't present itself, sometimes every now and then I get this itch, and I'm like, you know what? I'm just gonna trade this whatever, and I always lose money on it. So
Mm-hmm.
that's what I struggle with the most.
Any tricks that you're adopting to deal with that, to how to work around the challenge?
Yeah, I actually bought a Nintendo Switch. And so when my setup is not presenting itself, I might play a game or something like that, and
Okay.
just wait for it to present itself.
Yeah, good way to get that dopamine hit, right, from the game, and we don't have to get it from the market prematurely.
Yeah, exactly.
Well, great. Anything you're kind of looking forward to, or do you have any goals for yourself regarding trading or anything you're working on?
Yeah, I would love to. So I've had $160,000 month in February, and this month in May so far I'm up about 100,000 in May. I would love to have $100,000 day. That's the next goal for me. A lot of these traders that I look up to, they're having massive days like this. So I would like to do that, and then I would like to reach the $1 million mark. I think that's a coveted, rare air, if you will, for any trader to reach. I think you can call yourself consistently profitable after 100K. I think that's what I heard,
Mm-hmm.
and then a million, that puts you in legendary status.
Yeah, well, sounds like at least two members of your family and some of your friends you have already reached legendary status.
That's true. Yeah, it's all
Yeah,
it's all relative.
yeah. Well, Michael, thank you for coming on Chat with Traders.
Yes, sir. Yeah, and if people want to follow me or anything, you can reach me at IFYXXI on Twitter.
Fantastic. Thanks for coming on the show.
Thanks, Ian.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome to Chat with Traders, episode 284. This is your host, Ian Cox, and I hope you've been enjoying the podcast. We often hear that having discipline is the key to trading success, but many of us continue to struggle developing discipline and good habits for trading, no matter how hard and how long we've tried. Could there be a deeper reason for this? As fellow human traders, we are commonly faced with our own programming that we are often unaware of. In this special episode, Sam Degash, a professional coach and co-founder of the Conscious Trading Academy, specializing in helping traders overcome mental barriers, dive into aspects of my co-host, Tessa, and her trading mindset. If we cannot think greater than we feel, then this would compel us to be more aware of our mental states, which can sabotage our trading. I promise you this will be interesting. Let's dive right in.
Hi, Sam.
Hi, lovely to connect with you again, Tessa. How are you doing?
Yeah, I'm doing good. It's good to have you here. Would love to learn a little bit more about your background and how did you get into working with traders?
Sure. So my background, I'm a master practitioner and master coach working with various modalities in the neurotransformational tools. So these are like tools that works with our neurology in updating our conditioning, right? So our beliefs, behaviors, our emotional regulation, everything and anything related to our mind in a summary. And we can go in deeper in the conversation shortly. And how I came about working with traders, it was a coincidence. You know, I work initially when I started my career in the space, I was working with a lot of different backgrounds from all around the world, different people. And then I started coincidentally bumping into working with traders because we found like traders in Dubai is, you know, we have a big community of traders here. And that's where I'm based out. And initially I started working with them for other aspects of their life. And then it sort of somehow started pouring into trading. And then I started getting more inquisitive about trading and the trading psychology aspect of it, which allowed me to do more research and start to enable certain tools and modalities that work best for traders. And then my journey led me to working with traders from all around the world as I started expanding my reputation and people started to know about me, traders in the space. And then I came across my business partner today and friend, David Capablanca, through his podcast, The Friendly Bear. And then slowly but surely, obviously our relationship developed. I've worked with him personally and privately, and then obviously from there it became more and more. So trading space is a space where I focus on at the moment. And from that relationship with David, we decided to initiate, as you know, the Conscious Trading Academy in the trading space, which is combining the mindset and of course the skill set of David and as a master 7-figure trader and his great experience working with the mind. So what's nice about the journey of David in particular and myself is that we started to go deeper and more deeper in the work to see what it can actually involve. Like there were certain blocks that was happening, which I think we spoke of in a previous podcast. And that just started to develop the tools and the areas that most support and are most effective for traders. So using David and myself and combining those skill set is becoming more and more specific to traders, if that makes sense.
Yeah, and Ian actually interviewed David Capablanca last year, I believe it was last year, episode 257, and yeah, he's great. You know, there's a lot of terms that are thrown around, like, you know, there's trading psychology, you know, trading mindset, and those things. I mean, can we define that?
Yeah, sure. So I can define it in the best to define it is in the context of what we're doing in our space. I think what's really fundamentally important to remember that we are beings of neurology, right? So we have experiences in our life that shape up who we are as an identity today, as a personality, and that's made up of our past experiences, how we perceive our reality, how we perceive the world, and more importantly, our emotional intelligence and how we react to certain things in our life. Everyone's different, right? So at the fundamental level, we have something known as our conditioning, and that's the area that I specialize in. So I want you to look at it as an operating system of who you are today. It's a sum total of your beliefs, behaviors, past experiences, your values, and what you think about yourself and what you think about reality, trading per se, okay? How do you perceive yourself as a trader? What are the experiences you had in your journey as in trading? What are the losses? What are the, you know, all of it encompasses in one. So, but most people forget, and this is a fundamental scientific truth today, is that we are unconscious beings. So 95% of who we are is habitual. We act, respond, think in a very unconscious way. And the moment our mind, which is the conscious mind, the 5% that is in charge of certain things, we autonomically and automatically react and respond to certain things in our life, right? And that is exactly the same aspect and exactly the same formula that applies to trading as well, right? So when certain things happens in our trading, we react based on the meaning we're giving that experience. And my role is to change that neurologically speaking. So I go in the depth of the unconscious mind. People know it as the subconscious mind. It's a popular word, subconscious, right? And I work with the neurology aspect. So I go, okay, so when you experience something in trading, how do you react? So when this happens to me, I react this way. I get emotional. I start to throw out the book of rules of my trading, and I start to react a certain way. So that reaction is the unconscious process of that identity and personality. My role is to lead with changing those reactions, changing those emotional responses that are affecting traders today. Because whether we want to admit this or not, a lot of the trading aspect is a lot of it is emotional, right? When we are in a trade, we start to have different thoughts that run through our mind based on what we're seeing. And now we start to respond a certain way. Some people are so disciplined that they exit when they need to, and some don't, correct? So that's the difference in personality. Those are the emotional responses. So my role, just to sum this up, look at me as a programmer that comes in and reprograms the mind for how it wants to respond and how it wants to behave. So if a person is lacking a behavior of being a disciplined trader, that's at the end of the day, it's a behavior, correct? It's a behavior. You either have it or you don't. What we do is we implement that. We put the fundamentals. So how do you become a disciplined trader? Not by talking, because talk therapy is just creating awareness. We actually provide the tools and the techniques. We call them neurotransformational tools that put the person in a very low state, calm state. If you like, think about it as hypnotherapy, think about it as quantum therapy, think about it as neurolinguistic programming. These are all tools or areas of work around the mind that enables us to recondition our mind, to think differently. And when we think differently, we feel differently. And when we feel differently, we behave differently. So it's all interconnected. It's not one thing or the other.
Also, I think it's important to know if our problem stems from deeper psychological issues, you know, that affect how we think and therefore how we feel and behave, versus issues that maybe it's just more like, say, a trader just beginning, that maybe they're just lacking the skill set. You know, they're lacking the technical aspect, or they have the wrong attitudes and mindset for trading, and not yet really, you know, the deeper psychological aspects yet. So don't you think that's like, how do you differentiate between those
Very good
things.
question. So
Yeah.
yeah. So just to take a step back. Now we look at a person, a trader. Now, when you need to look at trading as an education at the start, it's like getting a degree. You can't expect to come in and make money from the beginning. That is short-term thinking. Like when you go to study in university, you spend 4 years or 3 years to get a degree or an education that enables you to go get paid at a job, right? The trading space, there is a misunderstanding. So you definitely have to have the right skill set and the right strategies and the right experience to become a profitable trader. However, there are traders out there that have been in the space for 4, 5, 6, 7, 8, 9 years and even more that lack the mindset. They lack the right discipline. They're emotional. They have certain root causes from their past that enables them to, what I like to call, the inner child of them comes out and starts to throw their everything out of the window, because now they just there's fear, right? There is fear of missing out. There is greed, which is another emotion, right? So it doesn't really matter where you are. Yes, you have to study. Yes, you have to have the right skill set. But as important, doesn't matter if you're 1 year, first year trading, or second, you have to have the right mindset, and you have to believe in yourself, and you have to have the right language in your head, that voice that is supporting you, that is perceiving you in a way that is healthy for you, that believes in yourself. Because if you don't believe in yourself in the start and you just want to make a quick buck, obviously you're going to end up it's not serving you the mindset. So the idea is having the right fundamentals, the conditioning that is creating that ideal personality to become a successful trader. As one of my mentors would say, something within you needs to change. So our personality creates our personal reality. So something about you needs to change, so you start having a different feedback and experience in your trading. You could still have so much skills, but you lack the mindset. Then you're going to constantly find yourself stuck, because there's the root causes, there's certain traumas in your past, there's certain things about your relationship with money, for example, or your relationship with a fear of missing out, or greed, or you're comparing yourself to others. There's many aspects that are psychological that stem from our past. And this is really important. So who you are outside of trading, if you remember, we had that conversation off camera, is what brings you in trading. Like, you are the same personality has an impact in trading and outside of trading. So if you're lacking something in your life, you will find that same thing mirroring in your trading as well.
One of the core differences I noticed between the trading profession and other professions is that in trading, especially for those who are, retail or independent traders, the main difference is that we have to kind of set our own rules and standards for trading. Whereas in other professions, like say if you're a doctor or teaching or other 9-to-5 office type of jobs or non-office jobs, if you break those rules, you get fired. Whereas a retail or independent trader, it's easier to just break those rules and not have any consequences that keep you from trading again until you improve it. Many traders, including myself, come into trading with the wrong beliefs and mindset and attitude about trading to begin with. And that just leads to compounding problems in trading. Just naturally, we're attracted to trading because of the freedom that it can provide. Not only financially, but the freedom from having to be in a job and answer to bosses that we don't like or other situations. So then the problem is we think that trading is the answer to all of our problems. But in reality, for myself going through this, is that I realized that you have to change your mindset. You have to have a professional mindset. You have to come into trading knowing that it's a profession and it has to be taken seriously.
100%. This is something that David always preaches at the academy. He always mentions, this is why he's very professional in the aspect of treating it. That's why we say you got to treat trading like you're going to university. The first three years, you don't even need to look at profitability. Some guys out there don't like to hear this. But it's easy come, easy go, right? So you have to look at it as building the skill set, building the mindset, making sure you treat this like a job, and you're the boss of your job. It's a business at the end of the day. You have to treat it as a business. And in business, we don't use emotions, do we? We don't. We're more logical. So what we do is we need to be able to manage our emotional state. And this is where most traders don't, because they're running away from something. They don't want to go to the 9 to 5 job, like you rightfully said. So now they're so desperate. That's an energy, that's an emotion. I'm desperate now. So now they take desperate measures and they take higher risks. And then sometimes they blow accounts. And so there's that pattern where they're running away from something towards the something else, and that's not serving them. So what we like to educate our conscious traders is, like, first and foremost, you have to have that balance in your life as a whole. So you have to be going towards something and not running away from something in the first place. Because when we run away from something, we're running away from fear of going back. So I'm fearful to go back to a 9 to 5 job. I want the life of freedom. But it's just finding that balance of, okay, well, how sometimes I get away with it, but you could get away with it once or twice or 3 times, but there's going to be a time when you break your rules, and that's going to be the end to your trading, or you're going to have a big blow. We all know this, right? With traders happening around this. So understanding that, fundamentally speaking, is I need to build the principles in my neurology of, I need to see myself behave, program my mind to be a disciplined person. How does a disciplined person walk, think, talk to himself? How does he hold himself as a trader, right? We have to recondition, because if you've done something, this is how our mind works, by the way. If we do something in repetition of a pattern of 3, so those are listening. So a pattern of 3, if you have an experience 3 times more on a row, now you've created a pattern and repetition. So that creates a habit. So if I've done something 3-4 times and I have a certain emotion associated with it as well, it becomes almost like an addiction as well, because now I'm used to feeding through the hypothalamus in my brain that chemicals that make me feel a certain way. And those feelings don't necessarily always need to be good. They can also be negative feelings, but I'm connected to that victimhood mindset that the market is bad, my life is my job 9 to 5 is hell, and now I'm creating that reality that is pushing me away from what I'm actually meant to be striving towards, if that makes sense.
Yes, it does. So there are many trading behaviors that we can talk about, such as entering trades too early or too late, or missing trades that should have been taken, or taking profits too early, or not cutting off losers, or over trading, under trading, revenge trading, or trading with no strategy, trading with too many strategies, or having issues scaling up, and the list goes on. Because there's so many areas, if maybe we can focus on a specific area for today. And I was thinking that would be exiting a position, and it could be exiting a position to take a profit, or exiting a position that is losing. Because if I was allowed to choose just one aspect of trading that I can work on to improve right now in my trading journey, it would be exiting trades. Because that is one of the hardest things, because I learned that many of us can be really good at entering, and we oftentimes choose the right setups. We oftentimes can choose the right positions and start off great, but it's the exiting that messes us up.
So let me ask you this question, if you allow me. Now,
Okay.
I want to make this practical for you, because you're a trader, correct? So when you put yourself in a scenario right now, a real life scenario where you are now meant to exit a trade and you're not exiting. My first question to you would be, why aren't you exiting? What comes up when I ask that question? Why aren't you exiting in time? What's the first thing for you?
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital. Okay, let me go back to just a recent incident, and I actually wrote this down on June 13th. I was in a trade, and things were going well. The night before, I had everything, I had my trading plan and idea of what I'm going to do. And then in the morning, I had done my routine. I did some exercises, and I was like mentally rehearsing how I'm going to do better this time than the day before.
How did you mentally rehearse? I want to ask you that question.
I have been starting to visually, what do you call that? I've been doing mental rehearsals.
Explain to me your process, if you don't mind. I just want to know, want to break that down for our listeners. So, what is the process that you follow?
Okay, and it's not very structured, by the way. I love to experiment on different things, but lately I've been mentally rehearsing in the morning. To do that, I'm also lying down, and I do my exercises, but at the same time, I do kind of relax and then relax my brain, breathe, and I am visualizing. I have mental pictures of, when I see this, when I encounter this kind of situation in my trade, because I learned from last time when I messed up, this is what I'm going to do instead. And just kind of visualizing those charts. So I've been doing that.
I want to give you a tip. We call this priming your mind. There is a science behind mental rehearsal, which is bringing the brain waves to a specific level, to a specific theta level of brainwave. So now you're accessing the unconscious mind, the subconscious. Because if you mentally rehearse from the conscious mind, and you're just lying in bed and you're just a couple of breaths, it's not planting the seed. It's not creating the movie, right? So in order for us to access the unconscious mind, and I'm giving you some tips here, so this is going to be beneficial, you have to do something called as brain, heart, and coherence. So this is I would encourage everyone listening to this podcast to learn about brain and heart coherence, which is bringing you into a calm state, not the sympathetic, a parasympathetic state, where now your nervous system is calm and your brain waves move from high to lower brain waves. That is now opening the door to the subconscious. And when you do that, when you do the mental rehearsal, you have to first get yourself into a breath rhythm. So there's a specific rhythm of breath that you have to apply. We have a whole course on this. And what happens is, as you create this rhythm and breath, you now open yourself up, and you have to be a second person looking at this. We call this disassociation. So you shouldn't be in your eyes. You should be seeing it first as you're watching a movie, and then stepping into your body. So there's two approaches to it. So there's one, you're looking from outside as a second person, sitting on the desk, seeing the charts, rehearsing what you would do when you needed to exit that trade, for example, and then going in as in you're in your body, and you're also seeing it through your. So you see it both in both positions. You're creating what we call an integration. Now you're showing yourself, because the unconscious mind, for those listening, doesn't know the difference between what's real and what's not. So when I close my eyes and I mentally rehearse a disassociation, it almost feels like this is happening now in front of me, and then I'm in my body, it's actually happening to me now. So if you repeat that, and repetition is extremely important. So there's a process, there's a whole therapy called time paradigm therapy that I'm a practitioner in, actually. So we teach that. And what that does, it's literally creating new neural pathways in your brain. So it's creating a whole neural network that says, oh, okay, so when this happens to me, that's my reference. That's how my nervous system, my unconscious mind is going to respond to that. So it's very effective, but it requires repetition and it requires time daily to get that complete mind map integrated in yourself. So now when that happens, you know how to exit the trade promptly and you exit it when you need to. Because remember, the part of you, and I want to get into that, I want to ask that question, but I just wanted to comment on this because I think there's value here for yourself and for those listeners that priming the mind, it's not about just closing your eyes and doing a couple of breaths and imagining it. No, there's an actual process to it in order to speak the language of the unconscious mind, right? So there's actual tools that allows you to do certain things that are scientifically studied and researched that produce the neuroplasticity of creating something new in our brain, creating a new neural network, a map. So now you start to feel it and you start to see it. So we bring in the emotion, which is the glue, and we start to see it, which is the image. And there's a whole process around it. Again, I don't want to get into too much of that because that's like a whole segue, but I just wanted to comment on that. So let's go back to the question of when you wanted, I'd love you to carry on the story.
Yeah. So that morning, after doing my what I knew as mental rehearsal, but thank you for sharing that because now I'll try that.
No problem.
And so everything was going well, and I was feeling good and positive. The morning started, and market opened, and I was off to a great start. I think later on, a few hours later, I've been watching my position closely. I had several positions on and I was still doing well, but there's this one position that was going against the side of the trade that I was on. And I knew inside consciously, I knew that I knew what I needed to do.
Yes, that's the conscious mind.
Because I rehearsed it too.
Yes. Okay, cool. So you have an idea.
Yeah, and I've done that before. I was able to follow, before that, days before, I was able to follow my rules.
Perfect.
But this morning, that morning on June 13th, it's just like, I was like almost daring myself. I felt like,
self-sabotage, would you say?
Maybe. I was like, I knew what I was supposed to do, but I kept like being stubborn about it. And I was like, no, I'm going to prove that that it's going to work out. It's going to work out.
There we go.
And then it got worse and worse. And then it got even harder for me to get out because I was like, oh, I gotta, no. This is going to turn around. And then it didn't. And then I remember I was getting really emotional, and I was just exceptionally just more emotional than I have been usually in trading. And I find myself like hitting the desk. I was just like, no, I don't want to get out. I know I should be getting out. I actually said this out loud to myself because I was like challenging this whole thing about, following your rules all the time. And I was like, no. And I said, I don't want to get out. I just don't want to because I believe that I can fight with this and I can fix this, the market's not going to make me get out.
Right. So this is interesting. Yeah. Carry on.
Yeah. And so anyway, long story short, I did still end up positive for the day, but that position I lost on. And for some reason, it just really upset me so much more than the other days where I had a losing day. But that day, although I didn't have a losing day, I was really upset at myself for being stubborn and for not doing what I knew I was supposed to do. And it really bothered me because I know that I could have done, I'm better than that, but I don't know what it is.
So if you allow me, I'm going to comment on this. Are you comfortable for me to comment on a few things and I can open up some things or would you be okay to go there?
Sure.
Okay, to a degree at least. So I want to explain something. So first of all, your inner dialogue that's happening is an inner dialogue between you and yourself, right? There's that conversation that's going on. And usually that conversation, if there is conflict, what's what I like to call misalignment. So you're out of alignment. You're not you're not taking the command. You're not in charge. So there's a bigger part of you that overtakes your decision-making process. We can agree to that because that voice initially came and said, you got to exit. This is your signal to exit, right? To be a safeguard yourself, right? But then something else came in and said, no, I want to prove that I don't have to exit, and I want to prove that I don't have to follow the rules, right? I'm just following what you're saying, correct? So that part of you is more the unconscious mind. That part of you is more connected towards something emotional about trusting in your decision-making process and trusting in yourself and believing that you don't want to be seen to be wrong. And you don't want to prove, you want to almost prove yourself that you're not wrong, that you will get out of this, right? So that dialogue of, I want to prove myself, also sometimes, again, I'm not saying this is you, but I want to share this so our listeners can get value. Usually it becomes deeper in our conditioning, which is related to some belief system we have where we want to prove to the world that we're good enough, that we are right, we got this. And this is a challenge now. You want to challenge me. So now the meaning-making process becomes an internal dialogue between you and yourself. And that's the challenge where, no, I'm telling you to do something. No, I'm good enough. I'm better than you. And I'm going to show you that I can do this, right? So it almost becomes an internal competition. Now, the emotional charge that comes in, which is, you said to me, Sam, I was pretty angry with myself. I almost have that sense of resentment towards myself. Again, I'm just almost breaking it down as fast as I can. What's that creating? It's creating it's coming close to a root within us, an emotional charge. So somewhere inside of you, within your conditioning, when it comes to proving yourself to be wrong, you get emotional about that. You don't like to be wrong. So I don't even know you, and this is probably the second time we're meeting, correct? But I'm breaking this down, and you can comment if it's resonating. But if I had to project something, or should I say break this down, again, I need more time usually, but just for you to know, you have something within you that in your character, in your identity, in your personality, you hate to be wrong. Tell me if I'm reading that correctly.
I don't think you're wrong about that.
Okay.
No, well, I mean, I can be wrong and I can admit it a lot of times, but there's certain things like,
yeah, there's certain things that it becomes emotional to you. It becomes like a charge.
It becomes emotional.
It becomes a charge. And that usually comes from, if you break it down, again, I don't want to go public on this podcast with you, but if we break it down to our conditioning, our childhood, certain things about our parents, certain things that I grew up with where I had to prove myself, I had to show people that I'm better than them, I had to do something to get acknowledged or to get seen or whatever that may be. Again, I'm just giving some examples for our listeners. That's what ties in to this emotional charge and the state of being. So remember, the state is like a program. It's how you think, how you feel, and how you react. That's all connected, okay? Now think about a state like multiple programs that resides within you. So when something happens outside of you, like a losing trade, you don't want to exit because now the dialogue kicks in. Your state of being changes. You're not the same person you started that day, correct? When you were saying, I was feeling good, Sam, I did my little bit, but a different part of you came out, a different character, a different...
Completely different.
Right. So what is happening there? I just want you to know what's happening is a state of being is changing. So a different program is kicking in, and that state dictates, now listen to this, it dictates the range of behavior that falls under that state. So if I'm angry with myself and I'm angry about this trade, now I'm going to fight it. That's my behavior. That's how I react to it. I'm going to fight it and I'm going to stay longer and I'm going to try and get out of it and And even though I know everything I'm doing is wrong, but that's my limit. That's all I can do. That's that state producing that to me. So that produces that range of behavior. If you're following me here, right? So each state produces a range of behavior that dictates how you behave. It dictates how you're going to respond to that trade, to that setup, to whatever you're working with, right? And when that changes, everything else changes because now you end up messing up other things, or you end up acting. So you now start to don't see opportunities, you narrow your focus, and so forth. It's exactly the same thing with traders that have fear. You know, when we are now something is happening in my trade and I can't exit, I don't want to exit my trade, although this is my signal I need to, and I'm talking about exiting a loss now, for example. What happens a lot of the time is that traders don't exit the loss because they don't accept to be a loser. They perceive it as, I am losing if I'm exiting this trade. So now I'm a loser. I don't want to be a loser because my parents or my childhood always, everyone thought I was a loser. I don't want to feel a loser. So then I don't want to exit the trade. Or I don't want to exit the trade because if that means that I am lesser, I am not good enough as a trader. And I don't want to admit that I'm not good enough. I don't want to admit that my strategy is out of balance. It's wrong. My whole, I need to change my approach. I don't want to admit that because I know that my approach is the best and I believe that's it. There's no one else. And okay, well, you know what I mean? So there's always, what I want to break this down and what I'm summing up this point with, there's always a meaning-making process to you individually that is unique to you, Tessa. So you have that, you know, you see that and you're like, oh, I don't want to be wrong. You know, I don't want to be wrong about this. I don't have to listen to my rules. I'm going to recoup this. Versus someone else, well, no, I can't exit because if I exit, that means I am a loser and I don't want to be a loser. And I don't want to be broke and I don't want to lose money and so forth, right? So there's a meaning. But then there's another person like my partner and business partner and the Conscious Trading Academy students that we have and the guys we're working with from all around is looking at that and going, this is a healthy loss. I'm exiting. That's a healthy loss because it's not about not about the money you're making in the case here. It's about, that's a winning trade when you exit in the required time that you need to exit. That's a winning trade. That's actually a win for you. But the perception needs to change. The way you perceive it and the meaning you give it completely different. So now when you give it a different meaning, guess what happens, Tessa? You feel differently, right? Yeah. You feel different in your body. So you don't have that emotional response anymore. Now you're more disciplined. Now you feel good that you exited. You feel so good that you stick to your book of rules because that's what we call a healthy learning. You're not losing, you're learning. So that changes everything because how many learnings have you got today? Oh, you know what, Sam? I didn't make much profit today, but I learned this and this and this because when I exited, this is what happened to my trade. So therefore, now I need to change my strategy because that doesn't work. Now, a lot of the traders I work with, they come to me and they say, well, I don't have the discipline but my strategy is the best. So I'm like, okay, so you're telling me your strategy is the best. How do you know your strategies is the best if you keep breaking your rules? How do you know? So if you keep breaking your rules, you don't even know if your strategy is correct. The only time to give yourself a true assessment of the level of skill set you have is by sticking to the book of rules and to what you said you would be doing. That gives you a real picture. And of course, other elements that we do, which is journaling and making understand why you exited that trade earlier and the emotions that was associated with it and so forth. So we need to dig in. So once you understand where that's coming from, that's when you can start to change it.
Yeah. Wow. Yeah. So most of us traders don't know this, right? Going into trading, and I just to continue with that day, I realized, after, even though I was upset and everything, and I was upset, at the market and everything, and I was like, after I had calmed down, I wanted to show that I can be disciplined, and I wanted to show, I know this is not good to say, but I was still mad at the market. I was like, the best revenge on the market, and I know that's not good to say, but it helped me at that point to say it, is to show that I am disciplined and I can follow my rules, and I will make mistakes here and there, but I'll learn from them. And like you said, like from every loss or from, any mistake that I make by not following my rules, that is a learning opportunity that I will 100%. Learn and continue to improve. And 100%. That would be the best revenge in the market. That's what I thought at the time.
Well, look, you pre-framed it exactly, but you pre-framed it in a healthy way. The most important thing is understanding that dialogue that's happening is you're not trying to prove something to someone, meaning yourself. You're not having a negative dialogue. You're having a more compassionate, more trusting relationship with yourself, that you're not putting yourself down in that process. This is really good. So sometimes when a trader has a loss, they beat themselves up. The language that is happening in their mind is, I mean, I know this because I've worked with traders for many years now. When they truly open up and they tell me what's going through their mind, it's a complete disaster because remember, our unconscious mind takes everything personal. So if I'm speaking negatively about myself, and I'm swearing at myself, and I can't believe you did that, and why, and da-da-da, now your unconscious mind is like a little child. It takes everything for face value, and it starts to believe that you are that person. It starts to go, I am this and this and this. I am whatever you're saying. So linguistics is why neurolinguistics is important, because there's a connection with our neurology and the language we use. It's like your program, right? So what am I speaking to myself when I hear a healthy loss? What's the conversation I'm having? This is what you just said was the right way. I'm taking a learning now. I'm not being emotional about it. I'm not beating myself down. And I'm growing from this experience. I'm making adjustments. As long as you're making adjustments, that's the most important thing. Every single loss has to come with some learning and adjustment. But if you're busy beating yourself up, think about this, Tess, which a lot of traders do. They're busy having this negative dialogue, and they're emotional, and they're upset. They're not learning anything. And then they'll do the same thing the week after. And then they'll do it again. And they go, this keeps happening to me. And I've heard that so many times. That's the unconscious pattern that they need to break free from. And they can liberate themselves emotionally. Remember, the name of the game here is, how can you manage your emotional state? How good are you as a trader today to keep your emotions at bay? And if you can do that, and you do that through tools and learnings and pre-framings and scientific modalities today, if you know and you learn that skill, which is one of the important skills we teach, because it's so important. Think about this. Even in your life, outside of trading, you need to know how to regulate your nervous system. You need to know how to, when something happens, how to calm yourself down so the state, remember the program I was talking about, doesn't switch and take over. I need to put that at bay. I need to keep it at bay. I want to be in the driving seat, and whether we know this or not, this is the reality. And listeners can go check this up. This is available about our neurology. It's available about our unconscious mind. 95% of us is a set of programs by the time we're 30 years old that is unconscious. And the moment we get into a car and we think about something and we end up we arrive at a different destination, who do you think got you there? How did you end up crossing the road and going all around and traffic lights and getting to your destination? How many times has that happened to most of us, where we move from point A to point B and we don't even know how we got there? What's happening is the conscious mind goes inwards. You're thinking about something, and the unconscious mind comes out and takes over. That's how it works. The unconscious mind takes over when you're busy thinking about something within you. So understanding that what takes over needs to be a program, Tessa, that supports you in behavior and emotions and discipline, not a program that's going, move out of the way, Tessa. I don't want to admit that I'm wrong. I want to show that I can do this in the market. I don't want to admit, I know I can break my rules sometimes. And that's coming from an emotional place. Think about it, right?
Yeah. And you talk about emotions a lot. Can we talk about that a little bit more? Because emotions are natural. We're humans,
Correct.
Right? We're not AI robots or whatever.
Correct. 100%.
And how do we use emotions in a healthy way in trading? Because it's natural.
Sure. Yeah, so I love that question, Tessa. This is a great conversation, by the way. I'm enjoying this. So emotions. Let's talk about emotions for a bit. So what's important to remember is that every single human being, part of our neurology, part of our making, is that we have emotions, which is energy and motion, by the way. So, and it's a response to something outside of us. So we give a meaning to an experience and we react accordingly. Now, the idea here is, I'm not saying that you will not react. We are all human. The idea is, how long do you react and stay in that state? And are you able, emotionally speaking, to change your emotional state on demand. And we can do that today. We have the tools and the techniques that changes our state of being on demand, to change our nervous system by choice. This is one of the gifts we have as humans compared to every other species out there. We have on demand the ability to change our state of being and to come back to what we call balance, okay? Now, reacting is not the problem. We all react, but how do we respond is based on our emotional state and how long we stay there, right? Now, at the fundamental level, and this is an area that I specialize in as a practitioner, we have something called a gestalt. Now, this is very interesting, and I'm going to try
What is
and
it called again?
It's called Gestalt. Gestalt. Yeah, it's a German word for collection. You can look this up, Gestalt, okay? And what a Gestalt does is that it allows to accumulate all your emotional experiences of your past. So think about your body as the operating system. Remember I said it's a hard drive, right? Your body. And it stores every single experience you had. Now think of you as a trader, right? So every single time you felt a certain way around a certain trade where you felt fear, anger, frustration, that emotional charge gets stored in our body. Okay, that's where the emotions get stored. And over a time, because I'm having the same emotional response, now I create what is called a belief system, a pattern, because now my emotions are constantly going around a specific topic in my life. Now, when we have a lot of that emotions that we've built up over the years, we become more of emotional people. So we will have a reaction that is higher than someone else. So some people, some traders react much more intensely when they have a loss than someone else. We can agree to this, correct? Like some people deal with losses better. But why is that? This is the question. It's because our emotions are stored. And if I've stored so much trauma, so much emotions from my past over the years, even from my childhood, where now when something happens in this context of life, where I don't want to be proved that I'm wrong, because if I prove I'm wrong, it means I'm not good enough, or it means whatever because of my past. That brings up all the charge at once. That emotional charge comes up because that's the definition of that perception of reality, that experience. It brings up this type of emotion. So what I do in my private practice is I actually go in and I format that. I release all that emotion. It's like a folder that you delete. And it's incredible because you can go back, and this is measurable, by the way. So I can even do this with you, Tessa. So you can go back to any experience right now in your life, even 13th of June, and you can close your eyes for a moment and you think about that trade and what happened that day. And what will happen? You will feel something in your body. You will feel that anger, that frustration, whatever you felt then, it's still somewhere in your body, correct? If you really played it in your mind, like you sat there and you're like, now, why is that happening? It's because the body, which is the unconscious mind, doesn't know what's real or not. So it brings up that emotion. That's number one, right? But when you clear that, because there's still residue from that past experience, the charge is still there. You never really processed it. It stays with the memory. All memories and emotions are connected. So if you keep a lot of memories of you being frustrated in your trading, now you created a gestalt, a folder of all those emotions and how they made you feel. So anything that resembles a loss or not, or proving to be wrong, the emotions gets higher and higher and higher over time, meaning more heightened, more stronger. What I do with one of my therapies, and this is why we are doing extremely well in this space, is I'm clearing all the emotional charge. So you can go back to any experience in your life, and I mean any experience in your life after we do this type of work, and you will feel nothing. You can play it in your mind, and you will feel nothing in your body. Why? Because we've released the charge. Now, how is that good for you when you've released the charge? It's because when you find yourself in that situation again in the future, you will no longer have that same reference of emotion, because that's what you felt so many times before. Therefore, you will feel it again. Now the tank is empty. The folder no longer exists. So you have an opportunity to manage a new emotional response. You have an opportunity to think differently and have an opportunity to liberate yourself from that experience. So now you have a completely different behavior. Because remember, we can never think greater than we feel. So if I have a lot of frustration and anger from my past, I bring it into this experience and I'll feel it again now. So we only go beyond the feeling when our emotions is no longer existing. So it's not a problem anymore for me because I don't feel like it's a problem. You know, I say this a lot, and to my community and my academy, if people really get what I'm about to share, it changes everything. It really does. You know, most problems in our life, even in trading, it's only a problem because it makes us feel a certain way. It really makes us feel, it becomes a bigger problem when we feel it. But if we don't feel it for a moment, think about it, it's not much of a bigger problem. We move on much more faster and we focus on what we want to create for ourselves. But most of the time we're stuck in the emotions of our past, and therefore we keep repeating the same experiences, the same behaviors, and the same results in our life and in trading. It's all connected. It's really all connected. And this is where I need to always remind people that it's all interconnected. It's not, you don't sit as Tessa on your desk and you're now a different Tessa. You're the same Tessa that goes out with your friends. You're the same Tessa that reacts to different things in your life. You will have the same reaction in your trading. It's the same identity. Yeah. Think about it for a moment, right?
Yeah. So for, let's just say, it's not just for trading. This is for just, every aspect of your life, right? What are some practical ways that someone can help themselves if they choose to want to try it on their own? Are there any practical tips or ways that they can clear those built up, feelings and emotions that's in the body, like you mentioned?
Yeah, so very good question. So the short answer is, if you want to clear it, like you want to format, you want to release all of it, you need to do practitioner work. You need to do intervention work. That's the short answer. So you cannot release that on your own. You need a guide. You need a practitioner that walks you through the process using an actual tool to go and address that on a deeper level of the body, deeper level of the mind. Okay. However, what you can do yourself, for those that don't have the opportunity or the means to work with a professional, what is important and what you can do is you can learn to self-regulate your nervous system, your state of being when you are out of battle. Emphasize on is being empowered by the tools yourself, right? So we have certain things we do, which is inducing through a guided experience where you're reprogramming yourself and you are doing a certain type of breath that is releasing and getting you into a more peak performance state, a state that is serving you, right? However, the reality is, and full transparency, that on its own can only serve you for so much, because what happens is, if you are going into a trade and you're feeling good, that's pulling you down. It takes one little trigger that switches the program back on. So you have to go back and switch it on again. So it's almost taking more effort for you to go, okay, I'm not feeling good now. I need to go and sit again and do my practice. And then you do it again. And then you switch on. But you're still yo-yoing between two, because you are doing it by yourself, which is amazing. And you can regulate your nervous system by yourself, which is amazing. And that could sustain you for a good time. But it only takes one thing outside of you that is a trigger to one of your charge of your past experiences that brings you back into that state again. And the old part of you comes out and goes, oh, I'm the angry part that can't deal with the loss. You know what I mean? And I don't want to admit it, right? But that's the version of you that hasn't overcome herself. She's still stuck in that experience where she hasn't forgiven herself. She's a bit hard on herself. She doesn't want to be perceived wrong. And more importantly, it's all between her and herself, not the world. You're not trying to prove everything to the world. It's all a dialogue between you and yourself, where you want to prove yourself to be right. And that's the internal conflict that's happening. And that's coming from your neurology, right? That's the charge we're talking about. It's an experience and an emotion associated with it, and a meaning-making process. Some of them, beliefs are formed through that experience as well. So I want to move away from that belief, for example.
Yeah, I'm just wondering, because, we meet a lot of traders and then traders in our community, and, how are some of them able to just self-regulate so well? And seem to not have, they probably do, but seem to not have these issues, and they are just like master traders, and
they're
so
probably
talented.
working with a good coach and they're not telling you.
possible. Yeah.
So a lot of the traders, just so you know, and I'm sharing with you, a lot of traders work with professionals like myself that don't disclose it really. They keep that as their secret weapon, right? Or they're doing certain practices that they don't disclose as well that helps them. But also you will find these successful traders. Like, for example, I like to bring in my partner as an example, David Capablanca, because he's a beacon of light in this space, a 7-figure trader, one of the most disciplined people I've worked with in my career. And it's a process, it's an ongoing process, but he had to do the work. He had to release the gestalt I was mentioning you. He's done that. He had to deal with old demons of the past, with old emotions and limiting beliefs and all of that. So that allowed him to break free and break through to different levels. And this is why he continues to grow. We're always working with each other. We all spend time. We're doing the same thing in that our ecosystem. So we're always ever working on ourselves. And those traders that are grounded, that have profitability, that are sustaining, they are definitely behind the scene. I can guarantee you, working on themselves all the time. They're doing something for personal development. They're making sure their environment is good. They're making sure that they don't have influence from their external triggers, are all contained. They are aware of the triggers. They have dealt with them and so forth. And that is part of the growth as a trader. So, it's a holistic approach. There's not one thing that. It's a combination of many things that leads you to become, a trader, a master trader, I like to call it, someone that is actually sustaining and maintaining what they're set themselves to do.
This is very similar to like elite athletes, right? In sports.
100%.
They all have coaches and mentors, to help them break through.
I have my own, just for the record. Like we all need someone that can support us, especially when it's someone we can model, someone that's doing the right thing. This is how I like to, like, if someone is doing something that I want to learn from, that they're doing successfully, that's the type of person I like to work with, or I like to be mentored by. And also personally, at least in my model of the world, it always has to be, at least for my work, it has to be scientific. I always like to go and understand how our mind works on a neurological level. Okay, so what happens? Where's this emotion coming from? What chemicals are happening? Why am I perceiving it this way? So understanding the fundamentals and working with that part of you, that's where you grow. Like, you got to go to the places that are going to make you uncomfortable. You got to feel those experiences to let go of them. But if you don't face our shadow, that shadow keeps crawling in and more often overtakes us and self-sabotages us in some cases. I mean, a common one when we talk about self-sabotage. This might sound crazy to some of our listeners here, but believe it or not, if we have a cap in our self-worth, so if we feel that, I can only see myself making $100,000 a month. Okay, that's just me seeing. If you say to me, but can you see yourself making 200,000 or even 500,000 or even $1 million? Oh, no. Wow, that makes me feel uncomfortable, right? That makes me feel uncomfortable. Why is that happening? There is a ceiling within our being, within our conditioning that says, this is where it's like almost a prerequisite or a little box. This is your box. So if you come close to the ceiling of that box, I'm going to put you back in your box because that's what you believe you can, because that makes uncomfortable. The emotion state changes, right? So I've worked with traders in the past that when they reached a certain number, a figure that is related to them, all of a sudden they can't ever go beyond that number. And it's always the same number or in and around the same number. And this sounds crazy, but it's reality, right? I'm sharing my own experience working with traders. Maybe some other traders haven't had that. I'm sharing what I've had with my traders. And what's happening is the moment that happens, the meaning-making process in the mind goes, oh my God, it's just another number, by the way. It's just another zero. It's the same strategy, same thing. He does it every day. But when he gets to it, something starts to change. His state changes. He starts to panic. He starts to have fear. He starts to go, ooh, this is a bit much. And then something takes over, which we spoke about. And what I call self-sabotage is the process, which is the program, and puts you back into where you are more comfortable, which is your comfort zone. And then you stay there. So we need to break those. We need to understand, why am I feeling this way? Because that's something happening. You can't lie to yourself. I am feeling uncomfortable about this number. Cool. Why? Where's that coming from? And then you trace that back and you update the system.
Sam, can you give some examples of the traders that you've worked with that kind of money mindset problem, that you mentioned that has a cap? Once you get there, you're like, oh.
Yeah, sure. So again, because I sign an NDAs with my traders, I'm not allowed to disclose names, but I can disclose one name, and that's only because we went public. And I'll go back to making it easy. I'll bring up David again. So David was one of the traders that I've been working with for over the years, and working with him over the years, there was a time and space where this was before he was a 7-figure trader, that when he was reaching a certain figure, a certain number, his neurology and his mind starts to change and started to do what we call a comparison. So he was comparing himself and the money he was making to other people that he in the space, meaning non-traders, and it felt wrong. It felt unauthentic to him. It felt that it's unjust. And how can someone make a few $1,000s in a few minutes? That mindset, that it's a set of programs, of thought process that kicks in, that's coming from his conditioning. So David is an example that I can disclose because we've mentioned this online before. We've disclosed this before publicly. I worked with him in changing the beliefs around that. All the beliefs that sit around, what does he believe around money? What does he believe around making that? Is it unfair? Oh, it's unfair. Where did that come from? So really changing that and using tools, of course, to go in and reprogram those thought processes enabled him to feel more comfortable with working with hundreds and thousands of dollars today. It doesn't make him flinch. But he even mentioned, and he used the example once, that it felt like he was a pilot, and the closer he got to those numbers, it's almost there was turbulence. There was like turbulence. He kept saying, I felt like I was fighting, and there was like turbulence happening. Although it was the same setup, same things he was doing on a day-to-day basis, but that created that shock to him, that emotional response that wasn't serving him. And that was his cap. That's what he was sitting to. And that happens a lot, by the way, with many, many traders. It's a common pattern. That's why there's a lot of traders that get stuck around a certain figure and a certain number, because the perception of what that means to them in their mind changes. So working with $1,000 versus working with $100,000 versus working with $10,000, every single trader in the space today, it's all different to them. Some traders, $1,000, it's like $100. Some traders, $1,000, it means so much to them that it's like their life savings. That's the reality, right? So it's how does that make you feel is the answer. And when you change how it makes you feel, that makes you feel more liberated, and it doesn't overpower you.
So thanks for sharing about your work with David Capablanca, and going back to that, it has something to do. Did it have something to do with his upbringing? Or
yes,
because I can relate to that too. I'm experiencing that right now, but on the lower level, that cap. It's like, is this possible? You know what I mean?
So that's something to do with your conditioning, your past. How you were brought up around money, how you were brought up around self-worth. How do you perceive your self-worth? Everyone has a different level of self-worth, and that's not a taboo topic, right? It's actually something we should all be comfortable to speak about. And the nice thing is we can elevate our self-worth. We can change how our self-worth. So if my self-worth sits at a certain level in my life, therefore I believe I'm only capable of achieving X amount. And until I have the belief system, listen to this, a belief system that says, no, I can make millions, and I feel comfortable about it, and I really feel it in my body, and my body's not lying, because the body doesn't lie. The body, it's an emotional. So the language of the body is emotions. Remember, the language of the body, the unconscious mind, it's emotions. And emotions and energy never lies. So you can feel. So when someone affirms and says, I can be a millionaire trader, and if he believes in it, it's a different connection in the body. But if someone doesn't feel comfortable around it, or doesn't believe in it for whatever reason, which can all be changed, that's the good news, it changes how they feel around it. So it's a different feeling.
Yeah. Is it almost like fake it till you make it?
Well, you can't really fake it if you don't feel it. So I don't believe in faking. I mean, fake it till you make it is good when you are priming your mind, when you are conditioning yourself to see yourself in that experience. That's good. Fake it till you make it. But fake it till you make it without the feeling and connecting it emotionally in your body, it's not real to you. It doesn't land, it stops, it doesn't feel right. You need to feel what you are saying. You need to connect with it emotionally. So that's where there's no charge. There's actually healthy connection there, if that makes sense.
That makes sense, Sam. But I'm having trouble. Like you mentioned it a lot about connecting the emotions to the body, so that you can feel that charge.
Yes.
How do you do that?
So feeling something you are, have you ever heard of affirmations before? You've heard of affirmation? Yeah. So a lot of people do affirmations, right? So they stand up and they look themselves in the mirror and they keep saying, I'm this, I'm that, I'm this, I'm that. So affirmations mean nothing, mean absolutely nothing. They do nothing if you are not connecting with it emotionally. Because the body is the unconscious mind. Remember what I said, the body is the unconscious mind. The body is your operating system. So in order for me, how do I feel it? You need to make sure, ask yourself, why am I not feeling it in the first place? That's what you should be asking yourself. Because if you're not feeling it, there's a block between you and what you're wanting to experience. And usually those blocks are limiting beliefs, are negative emotions, are old perceptions, old ideas, old ways that you've been conditioned. Not necessarily you're doing this to yourself, it's just your experience of life to this date. Sometimes it's culture related. I work with a lot of Asian, and I'm just to give you something very beautiful actually. So I have a lot of Asian. I've worked in my experience with Asian traders. So when I say Asian traders, I mean descent of Asian. So they're originally Japanese or Chinese or but they're American or others. I've also worked here in Dubai with others. But one thing that is in common about the Asian culture, and I'm sure you would define this, is there is a sense of, we're hardworking people. We're very disciplined. We need to prove, we need to, not obey, that's not the right word, but we need to respect our elders, and we need to, show them that we're capable, and we need to show them that we're good, and we need to prove them that we are an A students, and we need to, because anything below A doesn't even sit well in an Asian home. We want all A grades, we want to be all high achievers, and if I'm not a high achiever, I'm not good enough.
Yeah. I can relate to that growing up.
So thank you for sharing and being, transparent about that, because I think it's important and I appreciate that. But now think about what that does to you. Think about that for a moment, what that does to you. What that does to you, it makes you now always in your life having to, and I say this with respect, of course, having to prove something to someone. Meanwhile, you're trying to prove that to yourself, by the way. But indirectly, you're trying to prove that to your parents. You're trying to prove it to maybe your siblings if you have any, but you're trying to prove something all the time. And this is one area that I've seen from my lovely Asian, I call them my amazing traders, conscious traders today, that have shifted because they've let go of that perception and that expectation, and they've taken off so much pressure off their back because now they feel more free to be themselves and to trust the process and to take it one step at a time and to reach the all-time highs of where they're supposed to be without the pressure of the self. You got to prove to me, you got to prove that you can't lose, and so forth. So I hope this is, and I appreciate you being in this conversation. I hope it's resonating, and I trust it is to a degree.
Yes, it is. You brought up something that's, pretty sensitive to me. I kind of grew up with that pressure,
Mm-hmm.
Pressure to perform and pressure to work in a safe type of job that makes money, but even though you're not happy and things like that. And that's, because, it's not my parents' fault, but that's how they were brought up. And
100%.
So it kind of just stuck with, me and my siblings. And so I think it carries on into trading.
No, I think it's for sure. It's not even, I think it's 100%. It carries on to trading. And this is why, first of all, I honor you. And I want to just say, take a moment and say, I respect you for pursuing what you want in your life and giving this trading experience working towards it and giving it a go and putting in the work, because you chose not to fall to the norm of the conditioning, and you chose to break free from it, to give this a real go for yourself. And that's a very good indicator that you trust in your abilities, and you are putting yourself first. So I want to take a moment and acknowledge that, because that's very powerful, and that's important that you give yourself credit for it, because from what I'm reading today, I think you're a person that you don't give enough credit to yourself.
Yeah, I'm pretty hard on myself, and doing all this it's just so hard. It's scary. It's scary to break free.
I know.
It's so scary, and trading alone is already scary, but it doesn't have to be. Yeah,
it doesn't have to be, but the idea is moving away from the pressure and bringing in the right thought process and self-belief, and doing things from a grounded with the right skill set, and taking things step without the pressure. Because imagine everything we're speaking about, like the level of, you mentioned you've been trading for a few years now, correct?
Oh, well, I've been trading since 2014, but that doesn't mean I've been trading for 10 years. Sometimes when I say that, people think, oh, you're a seasoned trader. No, I'm still, developing. And so.
But you have experience, right? You have experience, right?
Definitely.
So my thing to you and what I'm saying is, just imagine taking all that wealth of experience that you've gained over the years, and you put yourself into a space today where you've taken the wisdom and you've let go of all the emotions that was associated with that with the pressure and the disappointment and the resentment towards yourself sometimes, and the hard conversations maybe with the family, and all those stories, those emotional stories, and you liberated yourself from it, and you are now back to what I call the center, the balance, where it's just you and yourself, and you have no more pressure, and you are actually rooting for yourself. So you believe in yourself. Because what happens is, you must understand, when we grow up in an environment where the expectations are high, and we are looking to always prove ourselves and to be seen and to show ourselves that we are worthy, what happens is there becomes an inner critic inside of us, an inner critic that's ready and on standby to go, let me wait for you to make a mistake. And oh my God, I can't wait, because here mom's voice comes out or dad's voice comes out and starts to put you and make you feel, not so good. And that's a program at the end of the day. So when we understand that fundamentally, that's what needs to change, because you don't need to have that voice, because we both agree that our parents did the best they can with the resources they had. That's how they've been conditioned. Now, they did that to you because they thought that by the way they approach it, they're going to make you have a better life and security and all the rest that comes with it. Meanwhile, we know in our reality that we know within ourselves what makes us happy and what doesn't. No one can tell us what makes us happy and what doesn't. No one can tell us what freedom looks like. We want to break the pattern. The new generation of traders out today are traders that want to break the pattern. They want to create more financial freedom for themselves, because they want to move away from the old paradigm of thinking, the old paradigm of doing things. Play it safe. Do a 9-to-5 job that you hate and makes you feel miserable, but it's safe and it's secure and it's certain, right? Certainty, But in reality, it's killing your soul. It's killing you slowly, and it's almost your soul is screaming. Exactly, soul sucking and soul screaming inside of you. And we've all been there. Like, there's none of us that haven't been there. All of us have been in that space at one stage of our life. I call it the previous life today. But the most important thing is when you start to have everything in your being, in your conditioning inside of you, rooting for you and taking away all the pressure and having a better loving communication within yourself, then you start to believe you're worthy. Then you start to believe you're good enough. Then you start to trust in yourself more. Then you start to have more confidence. All of these qualities are qualities we all need as a trader in this trading space to sustain and maintain, not to wait for something to go wrong and then blame ourselves. I mean, it's a completely different experience if you think about it for a moment.
Yeah. Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest. Yeah, and you mentioned confidence. It's so important. I had to create that confidence for myself, just small little wins to kind of build up that confidence, especially when you're working by yourself, trading by yourself. It's hard. Like you have to work extra hard at pumping yourself up
100%.
and listening to other traders and podcasts like
Correct.
Chat with
Correct.
Traders and other podcasts. You
Correct.
have to like constantly do that. Otherwise, it's so easy to give up.
Yes, 100%, 100%. And remember, look, it's a process. That's what we always say. It's not something that's going to happen overnight. It's a process, but in that process, you have to. It's whether you realize this now or later, you have to have the right mindset and belief system and emotional intelligence to get you there. If those are playing against you, it just it prolongs the experience longer. It makes it more frustrating. And that's why, sadly, today, many traders don't succeed because they lack those qualities within them.
Yes, so true. I know we've gone past our time, but
No problem.
and I know
No
it's late
problem.
for you in Dubai.
No problem.
Thank you so much, Sam, for
Thank
your
you.
wisdom and for sharing your knowledge and sharing what you do with
Thank you.
us traders. For listeners who want to learn more about you, what's the best way to reach out to you?
Sure. Thank you for that. So anyone can reach out to us at theconscioustradingacademy.com. My profile is on there. My details on there. David Capablanca's details on there. That's the easiest way. They can also follow me on Instagram. I'm not a big Instagram person, but I'm starting to get on there now more and more often. It's sam.degash. They can follow me on there on Instagram as well. And they were welcome to reach out, ask any questions. We have a great conference that myself and David do in California, in LA, once or twice a year. The next one is coming up in October 11, 12, and 13. And we have traders from all around the world and across the US that come through for deep diving into the world of what we're speaking about, but also bringing in David's skill set and trading strategies as well, that just combine that holistic. We need the skill set. Like shouldn't forget, we need to be skilled traders. But equally important, we need to have everything else we spoke about today to make that journey much more easier for us and to really live that experience. But really, thank you so much, Tessa.
I remember checking your YouTube video on the last few conferences you had, and I really liked the energy, the kind of the vibe. And so,
thank you.
So both you and David will be there working with. Okay.
Yes. We host it. And we have a 3 days. And first day is a VIP for the VIP. We sit together and we on the 54th floor in the US Bank Tower, and we have a meet and greet mastermind conversation. And he also does a tour to his podcast for some visitors that like to see his setup. Saturday is the full conference day, which I'd love you to come, by the way, Tessa, if you're around. We have a full day conference with like-minded traders like yourself coming in, learning from each other, and having actual experiences. So I teach them how to program themselves. I do certain things that hasn't been done in this space, with all honesty. And then the third day, and then obviously David has his sessions as well. And then the third day, usually we have a guest speaker as well, and we surprise guest speaker. And we also do a mastermind in the Athletic Club in LA. Beautiful places. Sorry, I didn't mention Saturday. It's in the Hilton in downtown LA as well. And it's really just about bringing people together with the right intention and attention to grow, to self-develop themselves, but being practical about it, moving away from the fluff and actually going, here are actual tools and science that you can take home with you, and you can start learning how to apply it yourself. Like one of the things I mentioned today, for example, priming. How do you actually do that correctly? How do I condition myself? So these are the sort of things we like to get into and cover the science behind it as well.
Great. Awesome. Thank you again, David. Thank you again, Sam.
Thank you. And she calls me David at the end. It's beautiful. Well, me,
because you were just mentioning David, and I was like, oh.
Yeah, it's all good. David is a dear friend, and we are, we are one. And to be honest, we're very, very, very passionate about what we're doing. But Ian, thank you for being on listening, and really, Tessa, I really enjoyed the call with you. I love the fact that you were also open, and I appreciate the vulnerability that you allowed today. So I really honor you for that. So thank you very much.
Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Don't expect to have like this perfectly linear P&L curve that you're making money consistently every day. Expecting that is like having a boxing career without accepting that you're going to get punched in the face. Like those things go together. And if you look at traditional firms, there's a reason why hedge funds have an asset under management fee. There's a reason why big banks who don't have prop desks anymore, but have principal desks, also sell services. There's a reason why like prop shops give their traders a draw. You got to smooth out that P&L. So expect that. Otherwise, if you have like this unrealistic expectation of like an Instagram trader, which is like very popular right now, where everything is a profitable trade, you're not giving respect to the game.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome to Chat with Traders, episode 285. I'm Tessa. 2 years ago around this time, Ian and I took the helm of Chat with Traders, and what a journey it's been. Hosting alongside Ian has been an incredible adventure, and as always, thank you for your listenership and support. We hope you're doing well. So I'm not athletic, and I don't usually watch sports, but I've been inspired by the 2024 Olympics this year. Have you been watching? My favorite things to watch are gymnastics and swimming. It's just so thrilling and exciting to see them perform. The Olympians' focus, practice, hard work, sacrifice, and winning mindset is truly amazing. Does this sound familiar? The mental toughness, discipline, and hard work? Those aspects of the Olympians remind me of the similar levels of commitment required for success in trading. Some of you know that I've gone all in on trading in the past couple months, being even more quiet than I already am naturally, and completely laser focused because I am going to be a successful trader. There, I said it. For a long time, I found it hard to say those exact words to myself out of fear of failure and being embarrassed. Like, what if I don't do it? What if I don't make it? What if I can't do what it takes? I've come to learn that having the courage to believe in ourselves first is key because no one else can truly do that for us. And second is that we must want to embrace the journey and the hard work because guess what? There are no shortcuts that work in the long term. So if you're in that stage in your journey and this resonates with you, I hope you have the courage to tell yourself with conviction that you will become a successful trader. Say it out loud. Believe it. Hey, and by the way, listening to the inspiring guests we've had on Chat with Traders can also be a great way to stay inspired and motivated and not give up when things get tough in your journey. Speaking of inspiration, today in chats with Greg Magadini, a seasoned trader who started his career as a prop trader for DRW and Chopper Trading in Chicago, and also at some point he traded with SMB Capital. He eventually ventured out to trade his own book, basically bootstrapping crypto volatility through options trading and transforming 50,000 into 1.3 million in profits over 9 years without a down year. He also had the time to be an entrepreneur and co-founded an analytics platform. How did he do all of this? Well, you'll hear more about his journey and interesting strategies. By the way, for some, there may be some advanced trading terms and topics in this interview, but I see it as a chance to expand our horizons and learn about what other amazing traders do. So without further ado, ladies and gentlemen, we are so pleased to present Greg Magadini.
Greg, welcome to your first time here on Chat with Traders.
Yeah, thank you so much, Ian and Tessa. I'm very happy to be here. It's an honor.
Yeah, great. So tell us a little bit about your background.
Yeah, sure. I'd love to jump into it. So I'm 36 years old, French Canadian American. So I started trading about 15 years ago. Been trading derivatives, was really a focus on vol. My career really started in prop trading. So I did prop trading for about 5 years at a few different firms. And then in late 2015, I quit my prop trading firm to go trade my own book and have been trading my own book for about 8 or 9 years now.
What got you into the financial markets in the very beginning?
Early on, what really piqued my interest was the 2008 financial crisis, really trying to understand what was going on there. What was the kind of the background history to the housing crisis and what kind of opportunities does that provide? And that's really when I first discovered the markets. And then I think about a year later, I discovered options. Me and my good friend, Will Warren, who's very successful in his own right now, we decided to start doing options trading together and really kind of start digging into how do those dynamics work. And ever since then, options have kind of always been a focus of mine.
Mm-hmm. And what drew you to options specifically instead of just going long or even short stocks?
Yeah, initially, really kind of the shortfall side of the trade was something that was really interesting to me. It almost seemed like you could get paid for like putting in limit orders type of deal when you're selling cash secured puts, things like that. And then my friend was very focused on the long side of the trade or long vol, so he kind of dug into that side of the aspect, and we kind of discussed a whole bunch. And I just realized that options were kind of like this never ending pursuit. So you understand how the instruments work. Obviously, there's a lot of dynamics in the market itself that you're trying to learn, but then you get into the math behind non-normal distributions and why are options priced with them skew? Why is there a volatility surface? Why is the term structure different between different expirations? And then finally, you start getting into working with the options data and essentially understanding different types of models and calibrations and things like that. So it's just kind of this never-ending journey, and it's one of those markets that since it's so complicated, there's just more opportunities for edge in it.
Well, you dived right in after only a year. Dived into the more complicated aspects of options. Do you have a math or finance background in school or something that drove you to that?
Yeah, so my background is in finance. Did economics and accounting in school, and then did the CFA, which is not really option trading related necessarily, but it's just something that was interesting to me. Currently doing the FRM as well. That's just something else that's very interesting to me that I've just been working on, but it's very kind of a personal goal. As I've developed in my career, I've been more focused on learning to code, working with the data, analyzing sort of historical data, which I'm sure we'll talk about crypto vol a little bit later, and as well as just regular vol. But that was kind of the journey into my own trading.
So give us an example of some of the early trades that you made and what were your thought processes around that and kind of some of your early results.
Just kind of starting with the back half of the question. So when I started trading my own book, this was in late 2015. It was very kind of scary at first to sort of quit and go on my own. I had a little bit under 50K. I wasn't sure if that was going to really work out. Was that going to be enough? And so ended up working out pretty nicely over the next 8 or 9 years. Went from 50K and I pulled out about 1.3 million in profits from the market. All short-term trading, about 90% short-term trading, not like long-term investments or anything like that. And then really kind of my risk management strategy is just a hard line. So basically what I do is I trade a low six-figure account, and then every year I pull out the P&L. So I'm not trading for capital appreciation, I'm trading for income. And the average P&L or the median P&L is about 120% per year. I try to target 100% per year and really make enough money to, sustain a lifestyle, so to speak. In terms of different types of trades and setups like that, so one of the things about vol trading that's really interesting, or kind of broad picture, starting with vol trading, what's really interesting is vol has a couple components that day trading equities or something else doesn't have. So mean reversion is sort of the core value proposition to vol trading. So what I mean by that is if you look at sort of the median value of the VIX, for example, the median value of the VIX, depending on what time range you measure, is about 16. And so when the VIX is at 11, that in the long term, we're going to go back to that median value or the 50 percentile. If we're at 35, we know that we're going to go back down to that 16% level. So what happens is you don't really need to guess on direction anymore. You start guessing on timing. And so even though everyone knows that the median is sort of the target of mean reversion, the tricky part becomes that the obvious trade, or how I like to think about it, the obvious trade becomes expensive to hold. So for example, VIX is a great example. If you look at cash VIX is at 11. Well, if you wanted to bet that VIX is going to go back up, you can buy the VIX future. And so the VIX future will usually trade at a premium when you're in a low vol environment. So it'll be trading at 12, cash VIX is 11, all else held constant, that future is going to lose, about 1 point, down from 12 down to 11, or call it about 8%. So over 12 months, that really adds up. And so what happened, for example, looked at some of these VIX ETPs, let's just say UVXY, and you really compare 2017, which was like a record low vol year, persistently low vol, and you compare it to, say, 2020, which was obviously the COVID year where vol did massive rally. I think the VIX hit the 80 handle. One of those situations where if you were going to sell the top tick of vol in 2020, UVXY, and hold that short for 12 months, you would make about the same P&L than if you just sold UVXY at the beginning of 2017 and hold that short for 12 months throughout the year. So selling vol at the low is basically, give or take, as profitable as top ticking the 2020 COVID crisis and selling the tippy top of vol and holding that short for 12 months. So that really is kind of sort of the underlying core setup that I try to think about when I'm looking at vol trading. I'm happy to jump into a couple more like distinct scenarios, but that's kind of the broad picture.
Yeah. So my understanding is you had some experience at prop firms, and I kind of like to go back to that time frame. And I'm assuming that's before you ventured out on your own. And what are some of the things that you learned at the prop firms? And what did you trade?
Yeah, absolutely. So I traded at a couple places. I was actually pretty lucky to start while I was in college, like trading for a small prop firm, a family office. I didn't really learn a lot of strategies here, but I learned really what it was like to trade other people's money. Someone gave me a small 5-figure account. He wanted me to try to make 25% per quarter. That was sort of the benchmark that we're aiming for. It's pretty high. And he didn't really have any strategy. It was kind of like do what you want to do. So one of the things that I started trading was kind of options on a delta basis to try to essentially make that money. I think the first quarter actually did make the 25%, and then the next quarter was like a small loss, and after that was a scratch, and after that we just decided to unwind the positions. And I was happy to have 1 year of experience, but it was one of those situations that most of the experience came about dealing with someone else's money and trading with someone else's money. But along the way, I was reading a lot of books consistently. This is my early years. I think I've been trading for maybe 2 or 3 years at that point. Spent a lot of time reading books, trying to find strategy, work, things like that. And I came across One Good Trade, which is kind of its own beast. And when you think about day trading equities, a lot of sort of the mental preparedness comes from almost being like an athlete, looking at charts, practicing your setups, having game set mind in the morning, and getting ready to deal with contingencies and stuff like that. Very different from sort of maybe the nerdy quant sort of model of trading. That was very interesting to me. I had never really come across that, so I ended up getting in touch with those guys, doing a summer internship there. I met some amazing traders. Peter Toe, one of them, who became one of my great friends, who's probably one of the best equity day traders that I've ever met. One of the great things about a prop desk is you get surrounded by like these amazing traders. You get to chat about different ideas. So that was kind of interesting. But truly, my professional career in prop started when I finished college. So I went to Chopper Trading in Chicago and DRW in Chicago, and that was a very different model. So if I look at a lot of people, when they think about finance, they think about London, they think about New York. Chicago is kind of a lot of people don't think about Chicago, but Chicago is really the capital of prop trading. And it's a very different model for prop trading than what you would see in sort of the New York style. So a lot of the traditional prop models are, you put up zero capital, you get to use their capital, but you get like a straight fee split. So call it 50% fee split. The Chicago model is also you put up zero capital, but they invest a lot into their traders up front. So, for example, most Chicago prop traders start off as a clerk. They also pay you like a base salary, so they call that a draw. So you're either making between 50 and 100K base salary, and then the capital that they allow you is just kind of on a bigger scale. And then also there's sort of a technology edge. So it's never really something you could reproduce on your own necessarily as sort of an individual, because you have sort of like this technology infrastructure stack that helps you get in and out of trades. So kind of a really good example is when I was at Chopper Trading, really where I got started professionally is trading the treasury basis. Treasury basis is a very kind of interesting product. It's a convex product. So if you think about treasury futures, for example, for anyone who's new to treasury futures, futures have a deliverable behind them, but treasury bonds are kind of not fungible. There's a bunch of different bonds that are closely related, but they're not exactly the same. So what ends up happening is that short treasury future holders are given sort of a basket of potential bonds that they can deliver. And so what happens is that you get this cheapest to deliver sort of methodology behind the future. And so what happens is as bonds rally, the cheapest to deliver would be sort of a low duration bond. And as bonds sell off, the cheapest to deliver will be sort of this high duration bond. So long treasury future holders end up kind of having this negative convex exposure. And on the flip side, treasury bonds themselves are convex products. So the dollar value of a basis point as bonds increase in value increases, and as the dollar value of a basis points as bonds sell off decrease. So if you combine those things together, long bond, which is positive convex, short future, which is short negative convex, you get like this convex exposure. And that really starts to look option-like. And so a lot of the strategies there that you learn about are mean reversion strategies. And you're trading sort of these massive packages of bonds. It might be 20 futures by 10 bonds, something like that, or 100 futures by 10 bonds, depending on how big the bond size are. Usually it's $1 million. And then you do these mean reversion strategies. So that was something that was kind of interesting and a very different way of thinking about the markets.
Mm-hmm. Did you trade any other type of commodities or securities while you were there?
Yep. So the other type of security that I traded was grain vol. So that's kind of another interesting sort of strategy, very tech centered as well. So all the bond trading was all on screen, but in grains, for example, there's still sort of these natural commercial hedgers. So people were growing corn and wheat and all that stuff, and they're not necessarily going to have, General Mills is not going to have a trading desk necessarily. So what they do, or what farmers do, is essentially they'll want to hedge out their future crop production, and so they'll just route an order down to a broker. The broker will essentially split that order up with traders on the floor, and so there's kind of this natural commercial hedging flow, and so that's why there's still a pit on the floor for trading grain options. And then there's sort of the upstairs on screen where you can, obviously trade options on grains just like you would like an equity option. And so what happens is that, the sophisticated firms will have a desk that straddles both centers, both on floor and on screen. And essentially, as flows come in, they'll essentially take the other side of it and try to get some edge, getting in a position and out of a position. And then kind of as a broader portfolio context, you trade this across multiple floors and essentially start looking at relative vol between, say, corn and wheat. What are sort of the normal distributions of that relative vol? What are the typical correlations between the assets? Things like that. What's the typical beta between the asset? And now you have sort of you straddle the venues to get in and out of trades. So that really helps you trade sort of a type of trade that doesn't necessarily have like a super large edge, but it's sort of a persistent edge. And by being able to get in and get out at favorable prices, you can essentially really trade a nice core portfolio around that. And so that's kind of the thinking there as well.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So did you specifically seek out these, kind of trading these volatility opportunities, or did the firm specialize in that? Because it seems like you almost went straight to these volatility plays from a very early on, right?
Yeah, so that's a great question. So Chopper, the first firm, really specialized in trading the basis. So that was really their core product, and they were basically one of the biggest players in the game there. And they spent a lot of time figuring out the technology stack to get in and out of those spreads and things like that. So that kind of just happened to be how I got that. Like it just happened to be that I fell on that desk, so to speak. It was a very interesting product. It's not something I would have ever sought out personally, but what I really wanted to trade and have always wanted to trade is volatility. And so eventually I sought out the desk for trading volatility at DRW. That ended up being sort of the last one that I did before I went and traded it on my own. And one of the big reasons for wanting to trade on my own is that, typically with these types of role, you start off as more of like a clerk position. And so typically the new guys get stuck on the floor, but trading on the floor is actually like a very difficult skill set. So it's an old school skill set where you're doing a lot of like calculating spreads in your head. You have to be able to like know all the hand signals. You kind of got to like out bully the other traders, so you get heard from the brokers and can get a piece of the flow. Sometimes sometimes you take a bad trade just in order to have sort of favorable, consistent treatment from the broker. No one wants to take the trade. You'll be the guy who takes the trade. So when there's a good trade that comes on, the broker will kind of return a favor. There's kind of all these like little dynamics. The problem is that it's kind of a dying sport, so to speak. So it felt like it was a dead end, and the investment to become an extraordinarily good floor trader wasn't going to be worth it. Like in 10 years, this thing might be gone or whatever it is. So got to learn a lot, but definitely wasn't where I wanted to end up.
Were you able to trade your own account on the side?
So that's very difficult at a prop firm. You typically need to get clearance for every single thing that you do. So yes, you can put on like investments, but if you're going to be an active trader on the side, not really feasible, at least where I was, because you just got to get compliance, right off on every single trade. And these firms, like especially in the case of DRW, those are multi-strategy firms. So they do like everything. They trade bonds, they trade equities, they trade futures, they trade future options. They do so on a discretionary basis. They do so on a high frequency basis. They do so on a quantitative model basis. And so everything is being touched, so to speak. So there's always a compliance kind of sign off that has to go through.
And how long were you there, and what motivated you to leave and venture out on your own?
Yeah, absolutely. So I was there total about 3.5 years. And then what really motivated me to leave is really kind of A, not being stuck on the floor. And then B, one of the things that was really interesting is that a lot of people started going out and venturing out into crypto. So DRW is famous for, Michael Moransky starting the crypto desk over there, inspired a lot of people. And so essentially, a lot of entrepreneurs in the crypto space have come from DRW. And for me, that started kind of like ringing some bells. I had been following those markets for a little while, but I never thought about sort of going into them. And then there was just kind of this wave of people who eventually left DRW to start projects in crypto. And so I decided to dip my toes by trading a vol book and trading a crypto book. And eventually I fell into crypto vol.
So to give the listener some perspective, what was Bitcoin trading at back then when you decided to get into this?
When I first started trading Bitcoin, this was in 2013. It was about $600, or had just broke 200 going on to 1,000. So it was 600 when I got in. And in late 2015, I think Bitcoin was maybe 1,500, and then Ethereum was maybe $8. So very kind of low prices. Yeah.
What were the main attraction, points about crypto for you? Because after all, a lot of people saying, "Oh, it's worth nothing."
Initially, it was basically just looking at charts. Like when Bitcoin broke 200 and I first got into crypto myself, that was just like you buy the new all-time high break. Like this is a new asset class. No one knows what it's worth. It's making new all-time highs. Like you don't sell that, you have to buy that. It's almost like a no-brainer, especially with an asset that isn't crowded yet. So that was sort of the first initial aspect. And then there's kind of all these different sort of waves of sort of crypto opportunities. There's like the ICO wave. There's been essentially like today, like an airdrop wave, things like that. But to me, what's really interesting about crypto, and especially crypto vol trading, is that because no one knows what this is worth, and no one has 50 years experience trading crypto, it's really a truly even playing field. And not only is it a truly even playing field, but for the most part, especially at the time, there was maybe like 4 or 5 professional firms trading it, DRW being one of them, but everyone else was kind of a retail trader. And so a lot of, in economics, they would say efficient markets would make sure this never happens, but a lot of like kind of opportunities that you would see, just like a triangle arbitrage between 3 exchanges, for example. Well, that existed in 2014, 2015, 2016. And then really even to this day in the vol space, which I'm sure we'll talk about, there's a lot of opportunities that you would see in crypto vol that you wouldn't necessarily see in traditional markets because there's more players in traditional markets. So if flow is very one-sided, there's someone on the other side who's willing to take the other side of a trade. But in crypto, sometimes the herd just goes one way and the prices go crazy that there's so much pricing edge to be taking the other side of different types of trades that it's just kind of a profitable strategy. So if you have experience, you know what you're looking at, and you know what to look for, there's good opportunities there that you wouldn't necessarily find.
So you weren't just simply going long and holding on to it for months, kind of a buy and hold investor. What were you doing? Like, give us an example of these inefficient opportunities you were taking advantage of.
One of the things that I've seen that's very interesting trading vol is the skew. So, for example, if you're looking at the Bitcoin skew compared to, say, traditional equity skew in the S&P 500, for example, puts are usually skewed over calls, and that's kind of a persistent dynamic. One of the dynamics is the spot vol correlation. Another dynamic is the index correlation. So, meaning that when the index, when prices crash, correlation goes to 1. So the diversification effect of the index goes away. So there's more volatility to the downside. And then there's sort of the fear factor, panic as prices crash. There's volatility as prices go to the downside. Crypto is very different. It's almost like no one cares about it in a bear market, and bear markets are kind of a gentle grind lower. And then there's sort of this fear of missing out on the upside when markets rally. And so what some of the types of opportunities that I've been able to trade is, for example, when the let's say Q4 2020, the 25 delta call for Bitcoin was trading about 40 vol points above the 25 delta put. Typically, a normal skew range would be 5 to 8 vol points. 40 volt points is just like absolutely insane. And so
for our listeners, just so they understand, so that's saying that the price of the call options are essentially very high relative to where they should be or have been historically. Is that correct?
Yep, exactly. And so what that means you can do is that you could do some sort of like collar strategy. So basically you buy Bitcoin, you buy a protective put, and you sell a covered call. But because the call is so expensive, you could lock in 3 times the potential upside. The call is 3 times farther away than the current price compared to the put. So you have like a built-in 1 to 3 risk reward. So that's like a type of strategy that's very low risk, very safe, because you have maxed out all the potential losses, and you could like really leverage that thing up. And then you wait till the market gets a little bit more normal, and maybe the risk reward goes from 1 to 3 to 1 to 2, and then you take that off. And so you don't necessarily even have to wait for this thing to come all the way back.
So typically in the regular stock market, how often does this occur, and what would be a more normal range so we can get a perspective on the difference between Bitcoin and regular financial markets?
Yeah, absolutely. So, for example, if we're just looking at the S&P 500, let's just start with the vol level. So, Bitcoin vol on average is about 50 in the recent years, but it's been as high as 150 for 30-day at the money vol. And then if you just look at the VIX, the median or the average between 16 and 18. So the absolute vol level is a lot bigger. And then if you're looking at that skew, for example, like the 25 delta skew, typically in the S&P 500, the 25 delta put is going to be about 3 vol points above the 25 delta call, give or take 3 to 5. And then in Bitcoin, not only is it reversed where the call is more expensive, but typically it's about 8, but there's been scenarios like I just talked about where it's as high as 40. So that's kind of just a perspective. And one more kind of quick perspective there is that in traditional markets, the skew is like the dynamics of the skew are pretty consistent and stable. But in crypto, what happens is that if crypto is euphorically bullish and it becomes bearish, you'll actually get a scenario where the puts become more expensive. So like the variance of the skew itself is very high. So that's kind of another dynamic that's very interesting and that people don't necessarily think about. But that's just the nature of this being a new market, and things are figuring themselves out as the market has more consistent players and consistent flows. This type of like variance of the volatility surface will go away.
So you first got into crypto 2013. When did options start appearing for Bitcoin?
Yeah, so the very first options really started appearing on Deribit. And so I think the very first option traded in November 2016. And then really when I started trading it was in 2019, April 2019. And so to this day, this remains sort of the main venue. People trade crypto options, but we're starting to get new products. So CME obviously has the CME Bitcoin futures and future options. We've seen products built on top of those Bitcoin futures like BITO, and that type of product has options as well. So that's an equity product that's built on top of rolling the CME futures, and then there's options on top of that ETF. And now we have the spot Bitcoin ETF live, and hopefully we'll get options on that soon. And so what really I'm thinking is we'll start to see a lot of traditional flows from the equity markets start to affect crypto and the crypto vol surface. And so some of the different dynamics will start to be priced out.
So speaking of these inefficiencies, what did you notice over time period, say, for example, in the early bull markets of 2021, 2020, 2021, and then the subsequent bear market and the FTX debacle? Did these inefficient opportunities, did they expand or contract significantly during the bull markets or the bear markets?
Yeah, that's a great question. So just for context, just for our listeners, for context, there's a couple of things to think about when we're trading vol. So one of the aspects besides mean reversion is the variance risk premium. So basically what that means is, because owning a convex product is so attractive, typically to be a seller of a convex product or a seller of options, you need to get paid above expected value. So by definition, in the long term, over a large sample size, selling options has a positive expectancy versus buying options. And so in crypto, in the bull market, for example, what we would see is that because everyone wanted to get long exposure, a few things would happen. Vol started trading like huge levels over implied. So, for example, if you look at SPX versus VIX, the long-term variance risk premium of selling options in SPX is about 5 vol points. In crypto, the average variance risk premium is 20 vol points, but that includes the times that it was negative. So the extreme extended portions has been as high as like 35 to 40 vol points. And so options as a whole start to become very expensive because there's sort of this euphoria and I'm willing to get long at any price. So that's one component. The other component, and this is a lot simpler, but it comes back to the rates trading portion of my career, where you could trade the basis in crypto. So in crypto, the basis really compares the future price of Bitcoin versus the current spot price. And if you annualize that differential, you can get the annualized basis. So the annualized basis in Q4 2020 was as high as 40% annualized. So that means you buy Bitcoin, you sell the future, and you do nothing else. You just hold it to expiration when both converge, and you have an annualized return of 40%. That type of trade still exists today. In April 1st of 2024, the annualized futures basis was 30% annualized. So that type of trade still comes in. And so something else that we have to consider is not only do options become extremely expensive when we're in euphoric markets like 2020 or Q4 2020. And then the option skew becomes very extreme. So the calls are much more expensive than the puts. And then add in the rates component where the basis is very extreme. So you're trading futures options. The future is trading 30% above spot annualized. The call is way more expensive than the put in terms of relative vol. And then calls and then options as a whole are too expensive. So all those three sort of dynamics together create this very interesting opportunity. And then to your point, when we have market crashes, some of these opportunities flip around. So when the FTX crisis happened, so before FTX, we had Terra Luna, that was in June, and we had Three Arrows Capital, which is a big hedge fund or not a hedge fund, a big prop desk in crypto that went bankrupt, and they had to liquidate a bunch of assets. Well, those created huge sell-offs in 2022, so June 2022 and November 2022 for FTX. And the basis actually went negative. So futures were trading below spot. The put skew completely reversed. And so you had sort of the inverse situation of the bullish market. So to have that huge variance in the vol surface and in the futures term structure creates very interesting opportunities on both the long side and the short side.
So when the market crashed and the futures were trading for less than the spot, what strategy did you implement then?
Yeah, absolutely. So one of the most interesting one was on Deribit. So Deribit had Solana options. FTX was a huge backer investor in Solana ecosystem. They had a bunch of Solana on their balance sheet. And so when FTX went bankrupt, Solana took a disproportionate hit. And then the market was anticipating like the Solana balance sheet to be liquidated to push prices even further down. So in the futures market, crypto likes to trade this perpetual future, which you can basically think of it like a future that never expires, but the basis is paid out every 8 hours in something they call funding. And so in that type of situation, we had a crisis where Solana cash prices were at about, we call it $9 or $10. And then the Solana perpetual future was trading at a 30% discount. And that 30% discount, that differential is supposed to be paid out every 8 hours. So in annualized yield terms, it's just like, a crazy percentage number. And so there's those types of strategies where you can basically buy the underlying future and then either sell the perpetual or buy the perpetual and sell the spot or do that type of trade, basically betting convergence, or you just buy the discounted perpetual and just hold it and hope it pops back up. So those are some of the interesting strategies that were available.
So if one bought the perpetual at that time during the sell-off at a 30% discount to the underlying, and if they just held it, what would happen then, say, as Solana starts to recover? They're continuously getting like these dividends streaming into their account. And then would the dividends stop when the perpetuals, i.e. the futures, were equal to the spot price?
That's exactly right. Yeah. So there was $3 of convergence on a $6 perpetual. And the longer it took for that convergence, the more often you would get paid that $3 difference while you wait. So
wow.
Yeah, so it adds up pretty quickly for sure.
Why is it that these opportunities weren't pounced upon by Wall Street? This seems like a no-brainer.
Yeah, so that's a fantastic question. So the first question is like, why do these things exist in the first place? And then why is no one like taking advantage of them? So really kind of quickly speaking, why do these opportunities exist in the first place? Well, the first thing is when the market is in sort of this extreme fear of missing out, people are willing to pay a 40% premium on a future because they feel like the asset's going to go up 2x or 3x in the next 2 months. And so, 40% per year, but you only hold it for 3 months is really 10%, but the asset went up 200%. You're willing to pay sort of that difference. Now, another aspect is, you and I coming from traditional finance backgrounds, sell the perpetual. There wasn't necessarily a direct TradFi or direct traditional finance infrastructure way to do that. There's the CME contract, and I'll jump back to that in a second. But in traditional finance, a lot of people have prime brokers. So even though they might have, a certain amount of capital, they can use, let's say Goldman Sachs is your prime broker, they can use Goldman Sachs's balance sheet to essentially put leveraged trades on. But in the crypto ecosystem, once you get in the ecosystem, you don't necessarily have a source of capital for leverage. And the only source of capital for leverage ends up being these futures, these perpetual contracts. And so they reflect that 40% annualized reflects sort of the leverage cost of capital in the system. And so it's not that anyone has an alternative. It just happens to be that. So your opportunity cost of taking that trade is essentially whatever the opportunity cost is of being invested in crypto. Now, in traditional finance, the CME future, yes, you could actually sell the basis on a CME future. The problem with selling the basis on a CME future is that it's a difficult trade to manage from a cash perspective. Within the crypto ecosystem, you own Bitcoin, you deposit Bitcoin at the exchange, you sell the future against your Bitcoin. In the CME world, you have US dollars, and you kind of have to hedge those US dollars, or you have to invest those US dollars in some side of crypto in order to hedge the short CME future. And a short CME future has a pretty high margin requirement. So what do you do to do that? So really, this is where I think we're going to start to see these types of opportunities disappear because Wall Street will be able to step in. But one of the things is that now that we have the Bitcoin spot contract, because before we didn't have this, the Bitcoin spot ETF, because before we didn't have a Bitcoin spot ETF. Well, the Bitcoin spot ETF is a perfect hedge, not perfect, but it's a really close hedge to the CME Bitcoin future. So you can sell the future, and as prices rally, your long ETF position is going to offset the future losses. You couldn't do that before because the only ETFs were built on top of the CME futures themselves. So you can't sell the basis and buy a product to hedge it that also is on the other side of the basis. So now, for the first time ever, you can actually, the Wall Street can take the other side of that trade. Wall Street has a much lower cost of capital that mimics risk-free rates. So the Wall Street cost of capital for 1 year is around 5 or 5.5%, where in crypto is as high as 30%. So now we are, in my mind, we're going to see that convergence come in. And to my earlier points around vol trading, where the variance risk premium in crypto is on average around 20 vol points, well, once we get the spot Bitcoin ETF options, we'll see Wall Street be able to squeeze out that variance risk premium as well. That's what I think is going to happen in the next couple of years.
I see. So for right now, now that they don't yet have the options available on the ETFs, that's working in favor of you because you can take advantage of this, right? But once those options become available, then the big guys are going to get involved, and then your opportunities that you've been taking advantage of will diminish. Is that accurate?
Yeah, that's absolutely accurate. And that's structurally accurate. Cyclically, it's kind of hard to say because maybe the first day options trade, all the retail people buy a bunch of options and the opportunity is even more true. It's hard to say exactly the dynamics of the flows. But this is why I love to share these ideas, because these ideas, there's an opportunity to take advantage of them now, but they're not going to be around forever. And so, it's not like some forever secret. There's no magic recipe that's just going to be a perfect winning strategy and stick around forever. So, yep, I'm happy to share them now, and they will go away in a few years.
Yeah. So I've been hearing from some Bitcoin people on YouTube that supposedly, since the Bitcoin ETFs were approved, that Bitcoin cannot make meaningful advances when the futures open interest is very high, meaning there's a lot of leverage in the system, a lot of traders buying the futures because they can lever up 1 or 20 to 1 or more, and that it's in the interest of the people who want to get Bitcoin for the long term, maybe the ETFs or the whales, to shake out these leveraged longs periodically by instituting short attacks to liquidate them. Is that much of an issue? Is that, is Bitcoin being held back by these ultra leveraged longs?
So I think there's kind of two sort of answer this question. The first part is Bitcoin being held back. So in my mind, no, because what happens is I think the thesis is people buy the future instead of Bitcoin. So then the bid for Bitcoin goes away. So then there's no reason for Bitcoin prices to go up. The problem is that if people are buying the future or the perpetual, there's a transfer mechanism, which is the funding rate or the basis that creates an incentive for people to sell the future and buy the underlying spot market against it. So the bids end up still going into the spot market and moving the price higher. Now, the second part is there an incentive or a trade where the market is levered long to maximum levels, and then there's an opportunity to essentially shake them out and trade against sort of those shakeouts. So yes, that is 100% an opportunity. That's something, I started a company around crypto derivatives, crypto vol, and crypto futures. One of the things that we looked at a lot and started researching a lot and building sort of analytics around is at what prices does the open interest in futures really occur? So you can get a good idea of sort of the total concentration of levered longs or levered shorts in bull markets and bear markets, what prices those were done. And then you can figure out sort of the leverage ratio of the exchanges as well. So just kind of give a good example. So in traditional finance, all the trades get settled at the clearinghouse, and then the clearinghouse will publish sort of the end of day futures open interest. But in crypto, it's very different because every exchange is its own sort of settlement layer. And so they publish instantaneous open interest marks. And so what happens is you can actually look at all the trade data, you can measure who's paying the spread, and you can assume for the most part dealers are passive and takers are the aggressors who are paying the spread and establishing longs. And then what else you can do is you can look at the total open interest of the exchange, and you can look at on-chain, you can look at its asset base. So from there, you can see, okay, there's $1 billion in deposits, but there's $10 billion of notional open interest. And so that gives you a good estimate of the leverage ratio. And so now you can say, okay, the leverage ratio for these customers is XYZ. There's this much open interest that got established at this price. There's this much open interest that got established at that price, so on and so forth. And now you can figure out sort of what are the liquidation pain points, and all that data is collectible as well. So you can see liquidations in real time. So yes, that gives us a perfect idea of like where people's stops levels are, where people's pain points are, and like where there's potential forced selling because of liquidation activities. And yeah, those are great sort of trading strategies and opportunities.
Do you ever try to take advantage of those yourself?
So I mostly trade crypto vol. I haven't done sort of momentum trading strategies like that personally, but we definitely have customers and partners who definitely do that.
So in the stock market, we've heard a lot about the meme stocks and market makers supposedly needing to hedge their gamma exposure, meaning there's so many options being bought that they can be a driver for the stock itself when they try to maintain their delta neutrality. Does something like that exist in crypto? I mean, are the number of options being traded so high that the market makers end up having to do that themselves? They have to buy the underlying to hedge their exposure?
So that's a really great question. So in terms of market sizes, if I look at SPY open interest in the option market versus the market cap of SPY or the S&P 500 ETF, the open interest in the option market is about 200% the market cap size. In crypto, the open interest in the option market of Bitcoin is about 6% the market cap. So the relative size of the derivatives market is really, really small compared to spot. And so I don't think we're at the point yet where gamma or delta rebalancing from gamma exposure affects the underlying spot price, but here's what I do think it affects. So we spent a lot of time doing research and building tools around gamma exposure. Again, same type of thinking here where we have instantaneous changes in open interest. We figure out the way that we do this is we look at the spread or like the top of the order book right before a trade occurs and the top of the order book right after a trade occurs. We figure out who paid the spread, how did the best bid or best ask react? Is this a big iceberg order that's chopped into smaller orders? If so, then they should be all grouped together, so on and so forth. A bunch of different rules. And then from there, we get a final gamma exposure of dealers. And so, for example, today, dealers are short a lot of $70,000 strike calls. That's what the street wants to buy. They feel like there's going to be a rush to new all-time highs, so to speak. But because the market's so small, I don't think it affects the spot market. But Deribit being the exchange where all the dealers have their options position, the only way that they can hedge or rebalance their gamma exposure, their delta exposure, is by using the futures market at Deribit or the perpetual futures market at Deribit. So what happens is as we start to violate these levels, dealers hedge in the underlying perp. Funding is the translation mechanism that reflects this, and so you could get these sort of blowouts in funding or these new levels of funding exposure expansion and contraction.
So how often do you actually take a directional trade? Are you kind of delta neutral yourself, always looking for those spreads and locking them in so that you're not taking a direction bet one way or the other?
No, I definitely like direction. And one of the things is that even when you're trading vol, because the nature of volatility correlation, there's almost always sort of unless you're hedging that component out as well, there's almost always sort of a directional exposure as well. So, for example, and this is really what I've learned in prop trading, especially trading at those last two firms. A lot of traders will fade the move, and what that means is that you're not trying to guess the future like an investor would. You're actually taking the other side of a reactionary moment. And so, for example, the SVB banking crisis, that was a big moment. Well, that will cause a lot of markets to instantly kind of go haywire. And really, as a discretionary trader, what I like about this, me and my friends like to call this Cowboy Christmas, is because it's one of those situations where it's a sample size of one. And so there's no like high frequency firm that's kind of, figured out how everything should move in this type of situation. It's actually these are the times where like quant strategies break and discretionary traders have an edge. So I like to do fade moves. And one of the structures that I'll do is typically like a 1x2. So when vol explodes higher, and for example, I expect vol to like go down a little bit, I'll own the one and I'll sell two of the further out of the money options. And at the beginning of the trade, this might be delta neutral, but there's still sort of a directional component to it. If the market goes back down, if vol exploded higher as the market moved higher, vol is going to go back down if the market goes back down a little bit or does nothing. But if it continues higher, you're still going to get hurt on the vol side as well. So those are sort of the ways that I like to think about it. And really sort of the secret there is kind of managing that type of trade. Typically with mean reversion trades, you leg into the position. It's usually not like a one clip thing. And then you kind of scale into it and manage that trade over a few days and then kind of hold it for the meat of the move.
I see. So if we go back in time, say when the market was getting routed in late 2022 after FTX blew up and Bitcoin was, say, right around 17,000, give us an example of an actual trade that you would put on, going long or short, these different options, and how long did you typically hold them for?
Yeah, absolutely. So a great example of this in the FTX crypto crisis, you would have the put skew become very expensive compared to historical levels. So the out of the money puts are very expensive. Vol is high altogether. So the type of trade that I would do is I would buy an at the money put, sell two of, let's say, the 25 delta put, try to put that on at a zero cost or maybe a slight credit. And then if I feel like the market's still very sketchy, I might buy like a very short dated, way out of the money insurance, like premium, a high volatility option that's at the money. Well, an at the money option will have a very high vega, but the vega value compared to the premium is relatively low. So for example, like a 1 year SPY option that's at the money maybe costs about $28, but the vega is going to be about $2. But if I look at, say, a 5 delta SPY option, like something that's really far out of the money, the premium is about, call it $2, but the Vega is about 50 cents. And so the Vega in percentage terms of the premium is a lot higher. So what happens is, if you think about it mathematically, if you have an at the money option and you increase volatility, you own an at the money option and you increase volatility, the value of the option goes up because you might become more in the money from the higher vol, but the probability of being in the money is still 50%. You're still at the money, it's still a coin flip. But if you look at a way out of the money option and um, call it, when you put it on, it's 3 standard deviations out of the money, well, the probability of being in the money is about 15 basis points. But if vol goes higher, so 15 basis points is about 1 in 650, 1 in 650 times. But if vol goes higher, that you go from being 3 standard deviations out of the money to 2 standard deviations out of the money, then you go from 1 in 650 to 1 in 40. And so it's less about the extent of being in the money versus the probability of that option being good goes up so much. So that's why out of the money options have like a higher percentage sensitivity to Vega. And so in that type of trade, with the Bitcoin trade, any sort of calming down of vol, those 2 out of the money puts quickly decay compared to the at the money. And so now you got this very different type of profile and payout.
So during that time, did you see any opportunities that were so unusual, so good that you say, well, forget just doing it for the next 4 to 7 days or however long short term you were? Can we lock in something, say, for the next 6 months or a year, and then just go off on vacation or something? Is it any opportunities like that during those extreme times, either bullish or bearish?
Yeah, so there was one that was very interesting. This was actually during the COVID crash, and this is a kind of a longer term trade that occurred in the rates market, in the crypto rates. But basically, during the COVID cycle, long dated futures typically trade at a premium to short dated futures. And so when COVID crash came and Bitcoin dropped from like 5,000 down to 3,000, what you could do is that you could buy a lot of the long dated futures, 6 months out, and they were trading at like a pretty significant discount, maybe 5% to spot. And then you hedge that by essentially selling the perpetual. So the perpetual also has negative funding. So when you're selling it at the beginning of the trade, you're kind of making money on the right hand, but losing money on the left hand. But what you're betting is mean reversion. And so the mean reversion is that when the market calms down, people want to buy Bitcoin again. And that long dated future is going to start pricing in, positive carry once again. And then the perpetual will start trading at a premium once again. So your long dated future, you'll make the appreciation there in terms of price. But then the short perpetual will flip from being negative funding to positive funding as well. And that's one of those types of trades where, you can hold that thing for a long time and you can just kind of continuously make money on it, both on the perp side from funding and then on the long dated side from the relative appreciation. And so that's kind of one of those types of rare trades like that. So the funding rates are definitely something to look at in sort of tail situations.
And what about for say the last 4 months when we've been in this choppy sideways kind of market? What has been your strategies during this current market? How do they differ from before?
Yeah, so we've had a couple of really interesting strategies in the past, recently with the spot Bitcoin ETF, but also in the recent past as well. So one of the things in crypto vol that is not figured out, that's been figured out in traditional finance, is volatility events, quote unquote. So volatility events are something like earnings in the equity space, or non-farm payrolls in the bond space, or the CPI number. So one of the things that we've noticed is that a lot of the events in crypto, people don't know how to price them yet because there's just, again, sample size of one. So going back to September 2022, which I know is not 4 months ago, but just for example, we had Ethereum go merge to proof of work into proof of stake. And so when that happened, essentially the 1 day implied volatility into that event went from 80% annualized to 190%. So you had about 110% 110 vol point expansion going into the proof of stake event. And really, when the event happened, like the market didn't even, there was like not even a tick in the underlying. The underlying realized vol was basically zero. Nothing happened. And so the option market kind of really, really overpriced the potential for disaster. You can maybe argue maybe a disaster would have happened and it's not overpriced, but in my mind, it's one of those things where there's a really good opportunity there. In the past 4 months, when we had the spot Bitcoin ETF, we kind of had that same type of event where vol got really bid into the spot ETF announcement. Then we had sort of the fake announcement tweet where the SEC kind of fake tweeted or got hacked or whatever that the spot ETF was approved. And then we got a preview into the market reaction. Then vol remained consistently high, didn't really adjust at all. Then we actually got the reaction, we got the approval, and vol for the next 4 hours didn't even come in. So it was one of those situations where we're so used to traditional finance where the market instantly reacts, and people have like iterated and thought through all the different trades so many times there's very little edge left. But in crypto, like we had the situation where not only did vol get bid, but there was not even a reaction post event. There was one good counter argument to that where, well, maybe the real vol event is when the ETF actually starts trading so we can understand the flows and maybe that moves the market. But my counter argument to that is that you still have this conditional probability that changed, because you could have the denial of the ETF is now off the table. So vol should at least adjust for that conditional probability changing. But nonetheless, that was a great example of an opportunity that has existed.
How have your returns varied during the different market phases, from the bear market to the mega bull market to the sideways market, or can you differentiate? Is there much differentiation between those different times and then the type of returns that you've been getting?
Yeah, that's a great question. So my personal trading profitability has been pretty consistent year to year. I've never had a negative year. I think my worst year is maybe up 20%, but the median year is still about 100%. But that being said, the reason why I trade, I don't compound my account and I pull money out all the time. 2021 is a great example where, I blew up a CFI account. I was able to recover the rest of the year, but I took a really stupid risk, and it's just one of those things where the pullback in crypto cost me a lot. So basically, long story short, just to dig into it a little bit, we had sort of this mega rally, and then I kind of missed a bunch of sort of the trades that I wanted to put on, and I kind of missed a lot of the move, and I was just kind of frustrated. And so I decided to just sell like a couple puts that I figured like I'll buy crypto if it goes down here. And I oversold some puts thinking like, oh, like it won't get too bad. And then the market kind of had this nasty pullback, and we had all this dynamics that I talked about where the futures basis contracted and went negative, vol went up as the market went down, put skew kind of blew up in my face. And it was one of those situations where like, you lose like 50% of your value and you're like, I don't want to close this out. I don't even want to lock this in. And that ended up being probably one of my worst blowouts in my career. Very unpleasant, unfun. It's one of those things where, anyone who's been a trader knows that there's times where like you really hate yourself if you trade poorly. And so it was really kind of a tough time, but I was able to make it back throughout the year and end up the year very good. 2021 was a great year for me, but halfway through did not feel so good.
So did that experience drive you toward those more neutral positions where you're capturing reversion to the mean and out of whack prices?
So I still think I'm not against betting on direction. I think direction is very valuable. But it was one of those situations where if you're going to sell something like that, start buying a tiny insurance, like a throwaway insurance, like a very short dated option against your long dated option, something like that. because what can happen is that these things can just like move so fast that you're kind of stuck in a position that like you're just jammed with it. There's nothing you can really do about it. I mean, you could just take a huge loss, but it's just you get stuck between a rock and a hard place.
Tell us about any new TradFi crypto products on the horizon.
Yeah, absolutely. So obviously we have the spot Bitcoin ETF. We got the ETH ETFs to start trading today. So that's very interesting. So these spot products are game changers for traditional finance to start getting into the market. And then we're going to get hopefully options against these products. But one of the things that's really interesting is the existing products, BitO and BitX. Those are very interesting because I alluded to earlier today that they are ETFs that are built on top of the CME futures, which means they capture and are affected by things such as like the futures roll down or the contango, the basis. But then there's also different dynamics to them. So BitX is a 2x BitO. And so anyone who's traded sort of levered ETFs before understands sort of the decay component into these ETFs. So an ETF, if something drops 50%, it has to rally 100% to come back to even. So a 2x product, is really affected by that sort of that compounding decay where it always falls from a higher denominator and rallies from a lower denominator. This is even more true in a high volatility product. So that gets exacerbated more. So, a 75 vol product has 3 times the effect of the 2-time decay than a 25 vol product. And so crypto is a very good candidate to make that decay product play. And then the other thing to keep in mind is a product like BitO also pays out a dividend. So because BitO is a futures product, a lot of futures P&L as the market rallies gets paid out as a dividend. So this creates sort of like a concavity to the prices. So as Bitcoin rallies, BitO will underperform in price terms. So if you're trading something like that 1x2 structure, I guess really interesting because when
people's money or introducing other outside money into your system or is the liquidity there for you to do that?
So I've thought about that. I have like some really good friends and partners that I work with today that would be good for that. I've actually decided that is not something I want to do. That's a level of stress that I don't want to deal with. And it's one of those things where you're making a trade-off between time and money or flexibility and money. So there's a lot of stress in managing other people's money. Even on a prop desk, there's a lot of stress there that I don't necessarily feel with when I'm trading my own money. And I think I will forever not trade other people's money is my conclusion. But I have considered it. But no, I think that's my conclusion. I'll forever just trade my money. And it's nice to have the flexibility to do what you want to do. So for example, when I started Genesis Volatility, which was a crypto options analytics company, and later sold that to Amber Data. Well, the reason I could start that company is I had the trading profits to fund it, but B, I also had sort of the flexibility to double up my time. So instead of just doing my own trading research and keeping that for myself and trading it, I decided to make sort of that aspect, the data research, data management, data analytics part of it public, share that and sell that as a product and still trade it myself. So there's kind of that double use of time. And it's slightly different than trading other people's money and a little bit less stressful.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Kind of closing thoughts for our listeners. What do you think is realistic in this market in trading crypto and in doing what you're doing?
Yeah. So I would say as a trading career, and anyone who's done data science knows this as well. Like edge is noisy. Like parameters are noisy. So when you calculate, just like when you calculate correlation or vol, the change in the level of vol is noisy along the way, and so your edge as a trader is noisy along the way. And what I mean by that is that don't expect to have like this perfectly linear P&L curve that you're making money consistently every day. expecting that is like having a boxing career. Those things go together. And if you look at traditional firms, there's a reason why hedge funds have an asset under management fee. There's a reason why big banks who don't have prop desks anymore, but have principal desks, also sell services. There's a reason why like prop shops give their traders a draw. You got to smooth out that P&L, so expect that. Otherwise, if you have like this unrealistic expectation of like an Instagram trade, you can handle it. For me, if I traded my whole account and I lost all the P&L I had made over the past decade, I couldn't psychologically handle that. And so the way that I deal with that is that I don't put all my money. I take money out. And like we just talked about, I had a bad situation in 2021 where I lost a lot of money. It sucked, but like it wasn't the end of the journey, so to speak. And so I think that's really a way to think about it. Also, like trading is a long-term journey. It's not like you'd be much happier consistently making a little bit of money with real skill than getting lucky and making like $10 million on some luck. I know it sounds like you'd rather have the $10 million. I promise you, like you want to use it as a self-development journey. That's the true fun of trading. It's getting lucky on some trade. It's almost like it's like being like born rich. It's not the same thing as like building your own business and like earning it. That's how I think about it.
So is there anything that you struggle with as a trader? What do you struggle with most?
Yeah, so I think that, well, psychologically speaking, I think the emotional component has always been sort of the hardest struggle for me in trading, is like basically not hating yourself when you suck. And that can lead to like a bunch of like hard struggles, like doubling down or like trying to trade larger to like just make the pain go away. So like make the money back to make it go away. Over the years, I've learned how to deal with that. So now instead of like doubling down or like having bad trading behaviors, not only do I feel disgusted with the markets that I just like don't even want to look at the screen, I close out all my positions is step number one. Two is like I just decide I'm not going to trade for weeks or a month. And then three is like kind of take a mental break, like almost go on vacation. So that's something that's helped me deal with that. But in terms of like actual trade sticking points that I've been working on, one of the things is I'm very good at scaling in and out. But I think some of the other traders I know, some of the best traders that I've learned from, especially at Chopper Trading, they're very good at holding winners for a long time. That's always been something that's hard for me. The larger the winner gets, the more nervous I start to feel, and so that's a sticking point that I'm working on.
Mm-hmm. Well, great, Greg. Thank you very much for coming on with Chat with Traders.
Thank you so much. Really appreciate it.
Yeah, and how can our listeners get in touch with you?
Yeah, absolutely. So you guys can follow me on Twitter at GenesisFall. If you also want to check out crypto options analytics, you can go to pro.amberdata.io. And then I actually write a weekly newsletter talking about crypto vol trade ideas, completely free. That's amberdataderivative.substack.com.
Fantastic. Thanks for coming on the show.
Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors. Mobile apps made trading seamless. and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Yeah, you've mentioned in previous videos that it's all fine until there's a recession. What type of news failure and market reaction would convince you that the game is up?
The game is up, 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 up.
Yeah, like the game is up where
Like we're done. It's all over.
Yeah, the chickens come home to roost, and people.
So if we're going to make that argument, right?
I
think it starts with the idea of this. This is the bear porn. Okay, you want my bear porn? I'll give you my bear porn.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey traders, welcome to episode 286. It's Tessa, your co-host, alongside Ian Cox, the awesome host who interviews awesome guests on the one and only Chat with Traders. There's contrarian trading, and then there's consistent contrarian trading. Can you really make money by consistently going against the crowd? Does it take a certain type of personality to be able to trade this way? Jason Shapiro was featured in Unknown Market Wizards by Jack Schwager. But you know, this market wizard is no longer unknown. I mean, he is the ultimate contrarian trader, and we're so excited to have him return to the podcast for an update after 2 years since we last spoke with him. We get to delve deeper and really pick his brains this time into his counter-trend trading philosophy, learning about how he identifies overcrowded trades and how market positioning and sentiment rather than price guide his trades, and focusing on the underlying mechanics that drive market moves. You know, there's so much to unpack here, guys, and I think it's fun. And I would challenge you to see if you can come away with any ideas that may spark other ideas that you may have never considered before. We hope you enjoy this episode. Ladies and gentlemen, we're so pleased to welcome back Jason Shapiro.
Hi, Jason. How are you doing?
Good, good.
Yeah, it's been a while since we last talked to you. Like to welcome you back to Chat with Traders.
Good to be here.
Yeah, last time we had you on was, it was like 2 years ago in episode 245. Just like to remind our listeners, Jason was featured in the book Unknown Market Wizards. So get a chance to get another wizard to learn about. So since the last time we had you on a few years ago, has anything in the markets surprised you during this time?
I feel like I've been doing this too long to be surprised by what goes on, which is not to say that sometimes it's not shocking, but at the same time, been doing this a long time, and the markets do what they do, and you know, sometimes we can get a decent idea of why it's happening, and sometimes we have no idea why it's happening. So surprised in that I can't really be surprised anymore because I've seen so many things that have surprised me that it's almost like, you know, nothing surprised me anymore.
Yeah. So could you do a brief review of what factors do you look at to get you to go long or short?
So my fundamental belief is that the market is a discounting mechanism, and that the discounting mechanism is in fact positioning and sentiment rather than price. So I'm a counter trend trader. I don't counter trend things because of price. I counter trend things because of positioning. So when I see people are way too long something, I'm looking to get short. When I see that participants are way too short something, I'm looking to get long.
Are there any particular trades that really stood out for you in the last few years?
They're all pretty similar to me. Like I say, everybody gets super short, and then I'm looking to get long. So, a couple good ones that we were able to catch based on that this year was sort of this currency trade. I went through a period earlier in the year where I really didn't have very much going on at all. And then a few months into it, we started to get some crowdedness. So we were catching sort of dollar short trade really as early as like early May. We were looking at the Swiss franc and then the yen just before it squeezed higher, got super record level crowded short right on the lows there. So that was a great one to catch. And in particular, because, that yen trade and that whole carry trade moved everything else with it, obviously. And we did not have anything that got us short the stock market during that period. I didn't see the stock market as being super crowded long, but it didn't matter because we were able to catch, the currency trades. So I always say it doesn't matter where you catch these things, as long as you catch it. I remember in 2008, I had an up year. I was neither short stocks nor long bonds, which were kind of the headline trades. But it didn't matter. I had a positive year. My numbers were good, and people don't ask, well, how come you had a good year? Did you catch short stock? It doesn't matter. The bottom line is I made money, and that's all that really matters. And that's kind of how it's been this year too. I really haven't traded the stock market very much this year at all.
Why is that? Why is that? Is
Again,
that unusual?
it just wasn't set up for me. At the lows in the stock market, I saw people, and this is going back, a year and a half or so. We're very, very short, and I caught some longs there. But when that data goes back to neutral, that's where my edge is over. So I get out. So it went neutral, probably last early summer. It went neutral, which doesn't mean it's then going to go down. It means it's going to go up or down. But, it just doesn't, my edge isn't there. So I don't trade it. So I haven't really had stock trades, but I've had a few other trades that have worked very, very well. And of course, I've had trades that have lost too. But the currency trade certainly was my best and favorite trade this year because it really caught the meat of what was driving everything. So like I say, though I didn't catch the stock market short trade back in mid-July, I was able to catch the currency trade, which really drove that anyway. So what's the difference where you catch it, right?
Are we talking about the yen's making near all-time high or all-time lows actually in sometime in July? Is that
Yeah, right then is when we saw the positioning get record crowded, was right in the beginning of July. And before that, we saw it in the Swiss franc, which really was showing that same thing back in late May. And that one took a while to work, took about a month, but eventually worked and worked very well.
In July when you were seeing the Japanese yen being very crowded? What does that really mean? So you were seeing a disproportionate number of participants being short?
Correct.
Or being short the yen?
Correct. That's exactly what it was.
I see. And then, so how it appears to you on the Commitment of Traders report, it shows what very long bars representing heavy positions from the short side.
Correct. It shows the speculators in the Commitment of Traders report being very, very short.
And so you're saying speculators, and what was the other group?
Well, on the other side of the commercials. So they were very long, speculators were very short. And that tends to be when markets have a high probability of turning, and should they turn, high probability of having a big move, because you have all these speculators that are short, and as the market starts to go against them, they start getting stopped out. We start going through moving averages. We start doing all these things that these technical traders use, and they start getting stopped out. So I'm really just trying to front run that type of move.
So what was the trigger for the Japanese yen to actually go up? I mean, we hear quite a bit about the yen carry trade. What is that, and how does that impact the world markets?
I mean, the yen carry trade, the theory is that, interest rates in yen are very low relative to, say, the US dollar. So people will borrow money cheaply in yen and put that to work in risk assets like stocks. So when that starts to go against them on the yen side, they have to get out of all those trades. So they get out of their yen position and they get out of their long risk assets like stocks position, and it all just kind of craters down. That's the theory behind it all.
I'm just wondering, how is it that just a 1/4 of 1% rise in Japanese interest rates could trigger such a massive sell-off? I mean, that's not that much of an increase. Why did such a big sell-off occur on such a small interest rate increase?
Well, I mean, this is the thing about when positioning gets massively one-sided, right?
Mm-hmm.
If everybody that is going to sell yen has already sold yen, then when it starts to move the other way, there's nobody left to sell it, and they all just get squeezed out, and that's what happens. People will argue that it was about, okay, they raised 1/4%, and maybe they indicated that there's more to come, and that's there's some truth to that. But
T reports, could you have heavy participation on the short side, but yet the number of but that participation is spread out kind of evenly among all the participants, and such that each participant wouldn't be exposed too heavily. They wouldn't be too heavily leveraged, but you have broad participation, making it look like it's a crowded trade. And yet when it goes,
I mean, arguably, what difference does it make if it's one participant that's massively short, or if it's a whole bunch of participants that are short? It's a position that's very, very big out there, and doesn't guarantee that the market's going to go the other way. But it means if the market starts to go the other way off of some trigger, like the Japanese interest rate move in this case, that you can get a very big move the other way because all this positioning has to get out, and there's really nobody to buy it from because they're all in it. So
I see. So just a small number of participants trying to get out triggers what margin calls, because no one wants to take the other side of the position. There's no one left, and so a small amount of dollar buying back in would send these markets, or would send the Japanese yen up sharply higher quickly.
yeah, I mean, if you look at the LTCM situation in the late '90s, there was a small amount of participants that were putting on this trade that blew them out, but they were putting it on in massive size. And when it started to go badly, they all had to get out because they were getting margin calls, and there was nobody to take the other side. So they all blew out. I mean, literally blew out, right? And as it turned out, the trade wasn't even wrong. The trade ended up being correct. But in the middle of that trade being correct, it got too crowded. They got squeezed. There was no one to provide them with liquidity on the other side, and they all blew out. I mean, LTCM went out of business. Salomon Brothers went out of business, and all on a trade, by the way, that ended up being totally correct.
Do you have any idea what any of these players might use as an excuse of when it comes to a market being overcrowded? Kind of what's their rationale? Do they believe that it won't happen, or it can't happen for these
I
particular
don't think
reasons?
most people necessarily look at that. They're looking at the fact that they think that the trade makes a lot of sense, and if it makes sense for $1, then it makes sense for $100. So let's go for it, And that lesson seems to never be learned. I mean, the LTCM people were theoretically the smartest people on the street, right? And and they didn't get it, right? People have a tendency to think in terms of greed, you know, and that in the end is what gets them, I think.
So you have the old phrase, this time it's different, right?
I guess so, yeah.
Yeah. How long has the Japanese yen carry trade been going on? And in general, what's its level of influence over risk assets?
I can't really say what its level of influence is. I just know what people talk about and what the theory is. I don't know enough about how hedge funds finance their trades through the yen. I really don't know. It's something that has been going on for a very long time. We hear it in euro yen as well. Euro yen has always been sort of a risk on measure as well, with the same idea. If euro yen was going up, then that was positive risk assets, and vice versa. So that's been going on for as long as I can remember.
So just before the yen carry trade blew up, were there any signs in the U.S. stock market that it was crowded on the long side?
No,
Mm-hmm.
not to me, there weren't.
Any markets that you're looking at now that are showing you that they are very crowded, both from the long and the short side?
Right now it's gone after this whole sort of dollar thing the last few months, which was really where I saw most of the crowdedness, and now that has gone away. I don't see a lot of stuff right now. Arguably there is some overly short positioning starting to happen in the energy sector, particularly in heating oil and in unleaded gas, is starting to get there. And there's a couple commodities like cotton, things like that are getting close to getting there. But as far as stocks, bonds are just starting to get a little bit crowded, especially the long end of the yield curve. The 30 years are arguably getting to a point where people are a little bit too crowded long, which would make sense, I guess, because people are expecting interest rate cuts. It doesn't make sense to me why they would be buying 30 years because they were expecting interest rate cuts, but nevertheless, that seems to be what they are doing. So I think that there's probably arguably some crowdedness in the long end of the yield curve there at the 30 years. But as far as currencies and stocks and most of the commodities, I don't really see anything. Gold is getting close. Gold we saw as pretty darn crowded to the long side earlier in the year, and that went away. And now the market has again ripped higher to new highs, and now we're getting close to where they're getting a little bit extreme crowded on that one too. But again, not totally there yet. That's going to trigger a trade for me just yet.
I often hear about central banks supposedly buying gold. Would central banks show up in a COT report? Could we track what they do?
Only if they're doing it in the futures market will they show up. If they're buying cash gold, then they will not show up in the COT report, although it could show up. Arguably, the people they're buying it from might be using the futures to hedge or something. We don't know. That whole argument to me is you can be bullish gold, and I can make a hugely bullish gold case here on a fundamental basis, and that's fine. But if your argument is the central bank buying, I think that's silly, because I can remember in the late 90s when central banks were auctioning off their gold holdings, right?
Yeah.
And that was the low in gold, right? So the opposite argument then would have been, well, geez, central banks are selling, so you wouldn't want to be long gold, right? I remember every month they were holding these auctions to auction off all their gold holdings, the Bank of England and all these places, and that was right at the low. Gold has gone up a massive amount since then, right? If I recall, that was like in 98. So if you were going to be bearish gold because of central banks selling in 98, I think it was actually 99. So I mean, you were looking at $250 gold. It's gone up 10 times since then. So if you were buying from the central banks back then you should probably be selling to the central banks now, right? That's how I would see it personally. But everyone has their own read on how they want to read things.
So when a market goes from a crowded position, bullish or bearish, to say a very light position, is that a signal that players have just gone to cash?
Well, it's a signal that they've gotten out of those massive positions is really all it's a signal for. Whether they've gone to cash or whether they've gone somewhere else or wherever they've gone, But for me, when that happens, there's just no trade there, right? For me, because if I'm trading it based on positioning and there's no massive positioning, then there's no edge for my particular process. So I just sit back and wait for the next kind of low hanging fruit type of situation, which is a hard thing to do for me and for many people, just sit back and wait, but that I've learned over time is the best thing to do, sit back, wait for your process to give you an edge and then pounce, right? But just to trade around things just because you're bored or whatever, that's over time, I think, a big mistake and a costly mistake.
Yeah, so let's go into what you consider an ideal setup to go long or short. You talked about markets being overcrowded one way or the other, and my understanding is you're looking for a news failure day.
Right. So I think no matter how you trade, whatever it is you think, I think that stocks are going to go up or whatever because of this. That's fine. But you always want to wait for the market to confirm what you're believing, right? Because you don't want to be fighting the tape because you're not going to be over time smarter than the market, right? Fighting the tape is just a very dangerous thing. I'm right, the market's wrong, so I'm going to do this is a very dangerous thought process over time, right? So, what is a market confirmation? Well, for me, if I'm looking at, okay, everybody's short here, I'm looking to get long. What's going to be my confirmation? I do it on what I call a news failure event, which means this market's been going down. Everybody is super short. I'm looking into why that is. What's the fundamental reason that everybody's looking for that? And we can just get like into the Swiss franc trade earlier in the year, and it was all about interest rates differentials, right? The European central banks, including Switzerland, were cutting rates much faster than the U.S. The U.S. to this point still hasn't even cut rates at all, right? And so the interest rate differential is growing, and therefore that's bullish the dollar versus those currencies. So I'm looking for data that is going to support that interest rate differential. So in this case, let's say some weaker data in Switzerland, right? Since I'm looking at the Swiss franc, that should support that. And it comes out, and Swiss probably goes down after it, but then it pops back up and closes the day higher for no reason. That's what I call news failure. The news was bearish, and the market didn't go down. Well, why didn't the market go down? Is it that everybody didn't see the news? Oh, clearly not. Everybody sees the news. Everybody's paying attention. To my eye and to my belief system, it's because everybody's already short. So who's left to go short? Where's the marginal seller? And the market just showed you that. The market just confirmed that. If there was a marginal seller, they would have been selling on this negative news. Well, they didn't. The market closed up on the negative news. So that's my market confirmation, and that is where I will get long. And now I have two things that go on. One, despite the fact that it had this news failure today, it might in the next day or the next week or the next couple of weeks go down anyway on new bad news and take out those lows. Well, if it takes out the lows of that day, well, then I'm stopped out. I'm picking a turn. If it makes a new low, then clearly I have not picked a turn, so I'm wrong. So I stop out. Okay, there you go. I take my loss. I move on. The good side is when it works. So now the market starts to go up. Shorts start to get squeezed. It starts going up. They're getting squeezed. They're getting squeezed. The positioning data goes back to a neutral reading, and that's where I take my profit. So it's one or the other. And what tends to happen is, say my trades are profitable less than 50% of the time, but the profitable trades make multiple times what the losing trades lose. In the particular case with the Swiss franc, I think we ended up making 7 times what I was risking. So that means that makes up for 7 losing trades, right? If I have that one winning trade and I have 7 losing trades, I'm even, right? Mm-hmm. And that's really, as a trader, I think what you're looking for is these asymmetrical payout situations, right? You want to make a lot more on your winners than you lose on your losers, and that's, to me, is what trading is over time. So how to identify where those kind of situations are? One way to do it, I believe, is through positioning.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
How often are important news releases digested over days and weeks, thus necessitating scaling into the position?
No, I don't do that. To me, it's a one-day read, right? If we look at the classic example that I like to talk about a lot, since most people are involved in the stock market, if we look at the low of the stock market in October of 2022, okay, the market was getting bashed all through 2022 as inflation was rising, and the Fed therefore had to keep raising rates. And this was all seen as very negative for the stock market, and it kept going down. October 2022 came, we had a CPI report, which was the big number then, because everyone was so focused on this inflation thing. And we had a CPI report come out in October that was higher than expectations, and was actually the highest CPI number for the entire cycle, as it turns out, for the entire cycle. But we didn't know that then. But what we knew then was it was the highest number for the cycle up until that point, and higher than expectations that day. So again, given that the stock market was selling off on higher inflation, this should have been a very bearish number for the stock market. And that day, in fact, was, in the morning, a big down day for stocks, as you would expect. And by the end of the day, the stock market actually closed up. And that was it. That was the low. That was the exact low of the stock market since then.
Well, how crowded did it appear on the COT charts?
Truthfully, it wasn't. It was crowded, but it wasn't mega crowded at that point. But it got there in about January of 23. So a couple months later, the stock market had rebounded a little bit. It started to have another sell-off, and then it got super crowded. And then we had some news failure in there somewhere, and that's kind of where I got long stocks, was back in January of 23. And that trade lasted for about 6 months.
So do the impacts of the same types of news releases vary over time depending on the mood of the market?
Yeah.
I ask this because the markets rallied on the dovish July 31st Fed announcement, but then proceeded to go down sharply afterwards.
Yes, I think that they change depending on what is the sort of psychology that's driving the markets at the time. You know, sometimes we're in this mode where good news is bad news, and then sometimes we're in the mode where good news is good news. You know, so you have to kind of pay attention in a way to what that is, and where we are in that cycle, so that you can then figure out what actually a news failure is, right? And those things, like you mentioned, have switches, right? We were in this mode for most of the last year and a half where some weakness economically was seen as good because it meant lower rates, right? And that kind of switched, I would say, on CPI day in July was the big switch on that. We had a lower CPI, and the markets couldn't rally on that anymore. So, and then everyone started focusing on, well, gee, there's going to be recession and there's going to be weakness. And so we got into that mode, right? And where we are now, I don't know, because now we're getting both sides of it. You know, sometimes we'll go up on that kind of news, sometimes we'll go down on that kind of news. But that, to me, can be explained by the fact that the positioning really is not showing any kind of bias one way or the other. So the markets can just act in like a random fashion, which is what I think is going on here.
Just curious about markets where there is much less news flow. For example, I don't know, maybe say some commodities
Yeah.
versus the stock market. Are news failure days more pronounced in markets that don't have a lot of news flow because of the relative scarcity of the news flow?
Yeah, it can be hard to read news flow on some of these markets like coffee and, cotton and that type of stuff because they don't have a lot of releases, right? But they do have releases, like the grains and all that have a WASDE report every month. And there's some other kind of, supply demand reports that come out, but certainly it's nothing like the financial markets. And I get more trades, I would say, arguably in the financial markets because of that. But I do get trades in these other commodities. And, part of the news flow can arguably be a correlation flow as well, So you're looking at gold, and we know that gold tends to go up when dollar goes down, right? So you get a big down day in the dollar and gold goes up on the back of it and then fails. You can argue that that's a news, that's a piece of news for gold is that the dollar's weak, right? So I call it a correlation failure, but it's just sort of a subtype of news failure. You don't get a lot of fundamental news on gold, right? But it reacts in certain ways to other markets. So therefore, you can use the correlation moves as a signal.
So do you spend quite a bit of time just observing the various nuances in the news and how each market responds to it while you're waiting for the perfect setup to go in so that you can see the trend of how the psychology is evolving over time?
I spend just about all of my time doing that.
Wow.
Trying to figure out what it is that is theoretically making these markets move a certain way so that I can know when that thing happens, how should the market respond? And if it doesn't respond that way, that's giving me my read, right? I'm not here to belong something because I think that the news is going to be positive. I don't have any edge in knowing what the news is going to be. I unfortunately can't see the future, right? I don't have inside information into any of this stuff, right? So I can't trade based on that, right? So I have to trade based on letting the market tell me what it's going to tell me, read the tape. And to me, reading the tape means how does it respond to the input? Not what is the input, because I could never have predicted that, but how does the market respond to the input relative to how it should theoretically respond to the input?
How often do you find yourself coming across a potential trade where to you it seems like the ideal setup, and then you go in very heavy on that one particular market? Or do you set limits to yourself, no more than X percentage in stocks, no X percentage in commodities? How do you work that?
I don't go in heavy on anything. All of my trades are exactly the same, and therefore my risk is exactly the same. I personally risk 70 basis points on each trade, so I know where my entry is, which is on this reversal day type of thing. I know where my stop is, which would be, if I was buying this thing, would be the low of that day. So I put on as much into that trade so that if I am going to get stopped, I'm going to lose 70 basis points on that trade. And I picked 70 basis points because A, through back testing, and B, through 20 plus years of live trading, I know that 70 basis points is going to come pretty close to providing my portfolio with a volatility of around 7 to 8%, which is what I am targeting, which then brings me to, a return of around 15% a year. And that's what I do. Some people want to do more, they do more. It's all a question of your risk tolerance, right? But that's where my risk tolerance is. So that's how I do that. I have no edge, unfortunately, in knowing which one of these trades has a higher probability of working than any other one. I have spent much time with people that have worked for me and quants that have worked for me trying to decipher that, and we have never found anything that has been reliable. What I find is the trades that I hate the most are the ones that usually end up working the best, and the ones that I love the most are usually the ones that end up working worst. So I don't use any bias in that. I just treat all these trades exactly the same.
Anything you attribute to the trades that you dislike the most, sometimes performing the best?
I think because I have the same behavioral biases of everybody else. You know what I mean? The markets have a way of, of making us look like fools. It's just kind of the nature of the beast. So, I can sit here and I can justify, okay, this trade should be great because of the macro. I'm seeing the macro look like this and blah, 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 blah. And it's all very interesting and makes for some fun conversation. But the truth is, it has absolutely nothing to do with how I trade it. I put all my trades on exactly the same. I had, just as an example, I had a really nice trade earlier this year where I got short cotton. It was a very nice trade. I didn't think it was going to work at all. I thought that I was in my heart sort of bullish the stock market. I thought that cotton was more of a risk asset, just like anything. So if the stock market were going to keep going up, cotton was probably going to keep going up. So I didn't like the trade at all. But thankfully, I didn't listen to myself because that trade ended up making, just that one trade ended up making like my full first half of the year. So fortunately, I do not listen to my own bias because I have learned that it's no better or worse than anybody else's. I wish I had some magical ability, but unfortunately, I'm just a dude like everybody else. I have no edge in forecasting the future, unfortunately.
Could you give us an example, or maybe you remember that event of the news failure of cotton? Like what would we
I don't
hear?
remember exactly. Oh, you know what? It must have been, it was a report, a grain report, a WASI report that included cotton.
Uh-huh.
That came out very bullish for cotton. And cotton ended up going up and then closing on the low of the day. And so I got short there against the high of that day.
So whether you like the trade or whether you dislike the trade, you put on the same position size on the day of the news failure, and you don't add to the position. Is that correct?
I don't add to the position. No.
Okay, so yeah, and
I put on my risk size, and then I just say it's either going to stop me out, and I'm going to lose what I was expecting to lose, or at least close. There's some slippage sometimes, and if it works, then it works. I can't control it either way.
And what percentage of the time do your trades work?
Over time, the number's been about somewhere between the 37 and 40% winner.
So if you get stopped out, do you ever try to re-enter that?
Yeah, if the crowdedness is still set up as it was, I will re-enter on a new news failure event.
Oh, on another news failure. So to say if the market's really crowded, you have a news failure event on one day, you go in, you put your position in, and then say a few days later you get stopped out, but you still see, say, a week or 2 weeks later, it's still very crowded. Are there conditions that you would re-enter that same trade?
Yeah, a new news failure. Just the whole
new news failure.
Yeah,
Okay.
the whole thing just resets and starts over.
I see. In one of your interviews you've done earlier, you discussed about Barron's experts and their portfolios. Kind of why do they underperform? And I'm just curious, if they're good enough to get on Barron's, one would think that they have performed well in the past, enough for Barron's to call them on as experts. Do you consider them part of the consensus, and why do you think they underperformed?
I do consider them part of the consensus, and I think that is why they underperformed. Yeah. To say, oh, well, if Barron's is going to call them up, they must be expert. That's arguable. They must have a good marketing team. They must have a good PR team, right? I don't see Stanley Druckenmiller sitting on the Barron's roundtable. Those who know don't say, and those who say don't know, kind of thing, right? But given enough people on the Barron's roundtable, you're going to see consensus. A lot of this has to do with not wanting to lose your job, not wanting to lose your clients. And the most simple way to do that is to not do anything outside of consensus, right? Because if you lose money when you're in consensus, then you can say, well, gee, everybody lost money. Whereas if you lose money when you're against consensus, people are going to be like, what the hell are you doing? You're fired, right? So I think it has a lot to do with that psychology, personally.
Yeah, some of these people wanting to fit in, right?
Yeah, protect their job, protect their business.
In other videos, you've mentioned about euphoria and market tops. What are the signs of euphoria that go beyond just the COT report?
Well, I mean, A, positioning, and B, you can smell it. I mean, we had what I consider to be euphoria in copper, for example, back in May of this year, where yes, the commitments of traders were showing people were way too long, but you started hearing people, people don't talk about copper that much. It's maybe one of the more popular commodities with oil and gold and all that, and then maybe copper. But you started getting people on TV. It was copper became the new AI trade, right? Because we're gonna run out of electricity, and everyone's going to have to buy all this copper to make all these new, all this new electricity. And I still have it somewhere in my file where a guy came on and said this was the biggest no-brainer trade he has seen in his career, and that was literally a day before the top in May. When you start hearing people, there's no such thing as a no-brainer trade. I'm sorry. Never will be, never has been. Okay. So when people start talking about this is the biggest no-brainer trade I've seen, and this is after, of course, he didn't say this when copper was trading at 360. He said it was when copper was trading at 520, right? So after things gone from 360 to 520 in 3 months, now all of a sudden he's on TV saying it's the no-brainer trade. And it's not even just necessarily something against this particular person. You have to remember he's getting on TV and saying this, so somebody is making the decision at that time to allow him to be on TV. And they're allowing him to be on TV clearly because copper is making headlines and everybody wants to hear about it. And so they bring the guy on that's going to say that, right? That's what's going to get the viewership. So that tends to be when euphoria happens, right? When all you start to hear about is one thing, that tends to be when the euphoria is happening.
So you pay close attention to what's going on in the news and society and what have you to add to your list of tools in addition to the COT report to get a feel of how euphoric a market is.
I do.
You said back on June 16th, quote, "This is the most hated bull market I have ever seen." Tell us why.
I traded through, the late 90s, as we now know it, bubble. And I also traded through a few other bubbles in Asia and whatnot in my life. And this market has been going up for quite a while now, with a little break in 2022. But I did not see, and still have not seen for that matter, any of the signs that I saw in those other bubbles. When I was trading in late 99, all you heard about everywhere you went was all these people talking about how much money they were making in the stock market, right? I don't hear a lot of that going on now. I have been hearing more people tell me how this was a bubble and it's going to crash and all that. You didn't hear anybody in 99 talking about how this was a bubble, when in fact it was, right? I don't see that now. I see almost the opposite. I mean, right here, again, I wouldn't say people are ridiculously bullish, but I don't think that they're as bearish as they have been for the last year and a half, but more neutral at this point. But that's what I meant by it's the most hated bull market. Was I just don't understand. There was no euphoria. There was nothing. And I think that's a function of the fact that you had the people who were like my age who did get burned in 2000, 2001, 2002, right? And have promised themselves they would never fall for that trick again. And then you had the younger generation have the same thing happen to them in 2022, 2021, post-COVID. A lot of the younger generation got involved and was chasing all of these momentum stocks. And once those momentum stocks failed, They just sat on them and said, okay, I'll wait till they come back. And they never came back. You know, they lost, you know, all these Kathy Woods type of stocks, right? They lost, you know, 75, 85%. And now they have promised themselves that they would never fall for that again. And so therefore they have hated this rally for the most part, almost the whole way up. So that's what I mean by the most hated bull market.
I've also heard you say that people love bear porn. And I'm just curious, why would this be when most of the investing public invests or trades from the long side? Wouldn't they love bull porn?
You know, it's a deep subject, but I'll tell you this. I made a video, I don't know how long ago, maybe it was a year ago or so. I made 2 videos on the same day, just as an experiment. I used the same data. I used the same information. And on one video, I made the bullish argument based on that data and information. And on one video, I made the bearish argument based on that same data and information. And I posted them both within an hour of each other on YouTube. And the bearish one got 5 times more views than the bullish one. And the bullish one I called the bull case, and the bearish one I called the bear case. And the bear case got 5 times more views. So why is that? You know,
Uh-huh.
I feel like, you know, the short trade is the hero trade, right? And people want to be the hero. You know, anybody can say, hey, the stock market's going up, and 75% of the time it goes up, right? But it's the hero that gets the market going down, right? So everybody kind of wants to be the hero. So they make these bearish things. And I think that people are, while you say most people are invested from the long side, and that's clearly true, I think they are underinvested relative to where they, in particular, wish they had been, right? With the market basically at very close to all-time highs here, they clearly wish they had more money in the market, right?
Mm-hmm.
And they don't. And so, you know, it makes them feel a little bit foolish. And therefore, if the market came down, they would maybe feel a little bit better about themselves, and maybe they could get some of the money to work that they wish they had put to work. So I just noticed that people are very much more interested in hearing the bear case more than they're hearing the bull case.
Interesting take on psychology there. Like to transition to economics and get back to you were talking about copper. Some say that copper has a PhD in economics. Any thoughts on that?
Yeah, I mean, I get it. You know, demands for copper should be high in times of strong economic growth, and obviously low in times of weak economic growth. So that's why they say that. You know, why did copper go down? I will argue because people just got way too freaking long, and therefore they had to get stopped out, which they did. But you know, if we want to make the fundamental argument, you know, we can point to China, which has had was the biggest user of copper by far. And the economy clearly has sort of fallen out of bed then and hasn't really recovered very much. You know, Chinese housing and construction obviously uses a huge amount of the global copper supply. And that whole market has just been way overbuilt and has just died. So I think that is the fundamental reason why copper has had such a hard time recently. But that's not to say that it necessarily says anything about the the U.S. market. People came up with copper's PhD way before China even was a player on the global economic stage, right?
Mm-hmm.
Now they're probably the biggest player for that type of stuff, right?
Mm-hmm.
Maybe the PhD isn't has been lowered to a master's degree at this point. I don't know.
Yeah. Have the net longs or shorts reported by the COT grown steadily over the years to reflect all the new money printing?
Certainly in the stock market, the outstanding value, and the bond market, the outstanding values have gone up. I wouldn't say so in the commodity markets. They've stayed pretty much the same.
So what are your thoughts about the market saying that about the chances of a 50 point rate cut? How accurate has the market been in the past in predicting these rate cuts? And is there a way to measure how crowded this type of betting is?
I mean, at the beginning of this year, they were betting on 7 rate cuts.
Mm-hmm.
They were betting on 7 rate cuts this calendar year.
Oh, wow.
So how accurate was that? Right?
Yeah.
Not very. The positioning in the COT for fixed income can help in deciphering where people are positioned for that type of stuff. My personal take, which, as I've said before, I wouldn't trade off of my life depended on it, but I personally think it's a little bit crazy. I have no idea why they're cutting rates, why they're even talking about cutting rates. I personally don't get it. I guess they're trying to get in front of something, but I don't see signs of recession. I guess we're seeing some weakening, but you know what? The unemployment rate is 4.3%. It wasn't very long ago where the theory was that the natural rate of unemployment was 6%, meaning it could never go any lower than that, right? So how a move from 4.1% to 4.3% is so economically bearish, I don't particularly get. I also think that, and look, by the time we get to the interest rate cut, as we've seen the last few weeks, the market can move very quickly. This could be different, but I mean, the S&P is within a couple percent of all-time highs. Gold is within one day. Yesterday, it was on all-time highs. Bonds are within a couple days of all-time highs. So why do you need to cut rates? There's clearly plenty of liquidity out there right now to do what you need to do. You're going to cut rates into the stock market on all-time highs and gold on all-time highs. I think it's insane. But who the hell am I? I don't sit on the Federal Reserve Board. I don't know what, maybe they see something that I'm not seeing. I don't sit here and have a team of people forecasting, future economic growth for me. I'm just a stupid tape reader. So maybe they're seeing something that I don't see, but to me, I personally think it's insane.
Mhm.
But and again, I don't care. Let them cut rates.
Right.
What's important to me is how will the market react to that?
Right. So if the Fed gives the market what it's demanding and cuts rates by, say, 50 points,
Yeah.
and the market closes significantly down for the day, would that be an obvious news failure and a clear sign to go short?
It wouldn't be because it's not set up as a short. It's
Oh.
not set up that they're super long here for me. I personally think that if that were the case, I would be looking to short the 30-year bonds, which are very close to set up to a short here. If they cut rates 50 and 30-year bonds go up first, and then close down, I would be looking to short that. I think that would be the trade.
Oh, wow. So you've said
Which
in the
also,
past,
by the way, to me makes the most fundamental sense as well, just as an aside.
yeah, you've mentioned in previous videos that it's all fine until there's a recession. What type of news failure and market reaction would convince you that the game is up?
The game is up, 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 up.
Yeah, like the game is up where
Like we're done. It's all over.
Yeah, the chickens come home to roost and people
So if we're going to make that argument, right?
Uh-huh.
I think it starts with the idea of this. This is the bear porn. Okay, you want my bear porn? I'll give you my bear porn.
Sure.
You start with the argument that this entire thing is nothing but a Ponzi scheme. Okay, where they've been since '09, they've been doing nothing but printing money, right? And that is what has supported everything, right? Because at the end of the day, more money is what drives the prices of things up, right? Milton Friedman will tell you that, right? Or at least he would have when he was alive, right? That ultimately is what drives things up. So they print money. And somewhere, I don't know where, I don't even know if it's close or if it's not close. I have no idea, but somewhere, obviously, there's a limit to that, to how much money can be printed before there is a consequence. Now, we know the US has this special thing that the dollar is the reserve currency of the world. So therefore, the limit to how much money they should be able to print is probably a lot higher than anybody else. But there is still a limit because there is a limit to everything in the world, right? Physics will tell us that, right? My feeling is if they get to a point where there's some sort of recession, and let's say the markets are going down, et cetera, and the way that they decide to solve that again is to go back into QE and go back into printing money. Okay, that's fine. What happens if that doesn't work? And what it will look like, that not working, is they'll print money, they'll announce printing money, whatever, and the markets won't go up anyway. Stocks will go down anyway, bonds will go down anyway, and the dollar will go down. Now what? What are you doing now? Right? There's nothing left. At that point, it's over. Right? So that's what I would be looking. We're not there yet. We could be there within the next 6 months. Let's see where we go. Right? We get the S&P, back down to 3,000, and et cetera, and shit starts to hit the fan, and someone's in trouble, and all that. Then we'll see. Let them print money, and let the market react to them printing money, and let's see how it goes. Right? But to me, that is the shit hitting the fan moment when the Ponzi scheme is over. And again, I'm not here to say that happens in the next 6 months. It could happen in 60 years for all I know, right? But that's, I believe, what to look out for. And I do, in my heart of hearts, believe that is a real possibility, simply because of the psychology behind it. When they did it the first time in 2009, I worked at a large hedge fund, and I can tell you that the consensus on the street was there was no way that was going to work. It was super inflationary. It was bad, and blah, blah, blah. And of course, it did work, right? It saved the whole system and all that. So, but now this time around, everyone thinks that is the answer. That time, they didn't think it was the answer. Now they think it is the answer. So if they do that, people are probably going to buy into it this time, and then they're probably going to get burned. That's what I think. But we have to get to that point. Yeah, the difference obviously is that back then, the risk was on the bank balance sheets, right? And now the risk is on the government balance sheets, right? Everyone says, "Oh, well, the bank balance sheets are all fine now; they're all so well improved," and blah blah. I'm like, yeah, that's true, because it's all been shifted to the government balance sheets, right? If you think that the scenario I'm talking about means that the U.S. government is going to go broke, I mean, you talk about fighting City Hall. These guys will use obviously every trick that they could possibly pull out of their bag to prevent that from happening, right? But if and when that is going to happen, it doesn't matter what tricks they pull out of their bag, right? If it's going to happen, it's going to happen. And at a certain point, the more they try to stop it, the worse it becomes. So that's why I say, let them try to stop it by printing money, and then let the markets tell you that ain't helping. Let stocks, bonds, and the dollar go down on that. And then we got a problem. But, I'm not saying that's happening tomorrow. Let's let it happen first.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So to wrap up, the last question I have for you is, you said about a year ago, the less I know about these markets, the better I am. Tell us why. You wouldn't learning more and getting as much information as possible be better?
Not really, because I think sometimes you can overthink it. My process has worked for me, right? It's an edge, I believe, that actually has positive return expectation. So that's really all I want to know is, what is my process saying? That's all I need to know. I can sit here and talk about, Ponzi schemes and macroeconomics, and blah, 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 just like anybody else can, right? I went to school for economics. I get it, right? But I don't think it offers me any edge. So overthinking it is what I'm saying is can hurt more than it can help.
Well, Jason, I'd like to thank you for coming on Chat with Traders.
No, I appreciate it, man. It was great talking to you.
Yeah. How can our listeners reach you?
Oh, I have just crowdedmarketreport.com, which you can check out. On YouTube, I do videos quite often. Certainly once a week, I try to do a video that really focuses more on trading psychology than anything else. I'm not really on there every week and going, here's what the S&Ps are going to do this week, because I think that's stupid. But on YouTube, under Crowded Market Report, I have a bunch of that stuff. And then I'm on Twitter too. I post some stuff on Twitter once in a while too. And then we have a Substack that's free. But if you go to crowdedmarketreport.com, you can kind of pretty much find all these things. So.
Okay, fantastic. Great. Thanks for coming on the show.
Yep, appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You can't solve these things by discipline. So if you keep making the same mistake over and over again, and you think, I'll just be more disciplined next time, and then you make the same mistake again, at some point, you have to recognize, oh, this is me. This is who I am. And I obviously have 0 power to change this. How do I trade successfully in spite of this? Once a trader gets to that moment, it's a beautiful moment because they no longer beat themselves up. They no longer feel bad at themselves. And they start to build systems that work. They start to look at this saying, I am terrible. I'm always going to do this. How can I possibly trade with this flaw of mine?
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, welcome everyone to Chat with Traders. If you're new to the podcast, a special warm welcome to you and to our loyal listeners. Thank you for your support and listenership. You keep us going. So we're on episode 287, and I'm your co-host, Tessa. Can I say, wow? I'm so excited about this episode. What do Ouija boards, Scrabble tiles, Kiwis, and March Madness have in common, specifically with trading? And when was the last time you ran an experiment to test a hypothesis? I love experiments, especially when they're complex and someone else has already conducted it, and all I have to do is review the results and reap the benefits of their awesome work. But I suspect I'm not the only one. Well, today our host Ian Cox chats with Rob Reinhold, a veteran trader of 27 plus years in the financial markets, and he's also the head trader and founder of Maverick Trading. We reached out to Rob because we recently learned about a very intriguing year-long trading experiment that just concluded that Rob calls the Flat Earth Trading Society experiment. Yes, you heard it right, Flat Earth. I just love it. Well, I won't spoil the details because I don't want you to miss this episode. And all I will say now, though, is that as a day and swing trader, I found this discussion so refreshing and so eye-opening. After learning about Rob's trading experiment in more detail, which, by the way, was conducted in a live trading account and shared publicly, I felt so relieved and hopeful for all of us traders trying to make it out there. Friends, if you have been beating yourself up because of trading or had a rough trading summer, please don't give up. I promise this episode will recharge you. On behalf of Chat with Traders, and I dare to say the entire trading community in the whole wide world, thank you so much, Rob and your team, for conducting and sharing this groundbreaking trading experiment. And by the way, we'll have links and information related to today's discussion in the show notes for this episode on our Chat with Traders website. So make sure you visit our website, chatwithtraders.com. And if you haven't subscribed to our email list, please do so we can stay connected. Now, without further ado, ladies and gentlemen, we are so pleased to present Rob Reinhold from Salt Lake City, Utah.
Well, officially, Rob, welcome to Chat with Traders, and let's dive right into your background.
All right. Well, it goes all the way back to 1997. Got a hold of some early books, and this was the very beginning of online trading. I decided that that's what I wanted to do with my life, is be a trader. And I decided to play around and kind of do it on the side and ended up doing pretty well. And then, like most people, pretty much common theme in trading is you do pretty well at first, and then all of a sudden you find out it's a little harder than you thought. It's the Dunning-Kruger effect for sure when we all start trading. Are you familiar with the Dunning-Kruger effect?
No, tell us. What is that? Sounds like something related to psychology.
Absolutely. The Dunning-Kruger effect is basically you start with zero confidence and zero information on a subject. And typically what happens is once you get a little bit of information, your confidence skyrockets to the highest point it will likely ever be. Even though you don't have any of the actual experience, you have this confidence that you do. And then the confidence comes down as you realize it's a little bit harder. And then at some point it bottoms out and actually starts to go higher again in the future, but you never really get back to that very first point of where you knew it all. And that's really probably around the 3 to 6 month mark of trading. I don't know. Did you ever experience that?
Oh, yeah. Yes. But maybe thankfully for me, I started off with some losers. So I got the education done early.
Perfect.
Yeah.
So I lost some of my money that I gained, and I learned about a trading firm called Maverick Trading in Salt Lake City, Utah. And I went in there and I was able to sit with other traders who had a lot more experience than me. And I can't tell you how much I learned just sitting next to people, because I had my way of doing things and I thought, hey, it's going to work. I've done some back testing and I was a real big fan of indicators. And the guy next to me, he was always buying things that had already gone up like 10, 15, 20%. And I thought, this guy's insane. This guy's crazy. I mean, he's just chasing things. And so I would buy the things that, quote, hadn't moved yet or were trading at a good price. After about a month and watching him pretty much win every day and me, have okay results, I realized, there's a lot more that I need to learn about this. So that's really where I started out, was 1997 and very early in the online trading game.
1997. So that was during the dot-com boom, right?
Yes. Yep.
Right.
The boom and then the bust.
What made you seek out a prop firm? Because I remember I was trading back then and I didn't even know such a business existed. All the traders I knew, they just traded from their computer and they thought that was good enough.
At that point, Maverick Trading actually was not a prop firm. They were just a regular broker dealer. The difference was you could go into their office and they had a T1 internet line. They had all the systems to where you could actually trade real time. Because if you remember back in 97, you really couldn't get internet in your house that was reliable at all enough to trade. So The only way you could really do this was to find a firm that had an office.
So you didn't have any other career aspirations? I mean, did you get sucked in? Back then, there weren't any Lamborghini videos showing off how much money traders made, right? Did someone introduce you to it?
Well, I'm trying to think of how I got introduced to this first. I met a gentleman who did some real estate when I was 19, and I thought that was just really cool and just a really cool way to do business. So I got all fired up about real estate, and I started doing stocks on the side. And I just realized that stocks were a lot easier than buying and flipping houses. I love buying and flipping houses. It's still something I think is just phenomenal. But it's a lot of work, and your capital is tied up for like 6 months. So I was having this boom and bust where either we had a lot of money or we had a bunch of houses that needed to sell. And I just said, I want a more smooth existence. And of course, again, Dunning-Kruger effect. Oh, I want a smoother way to make money. Let me be a trader.
When you started taking losses, is that when you discovered the Dunning-Kruger effect? Did you seek out this knowledge?
Seeking out this knowledge, I'm not totally sure what you mean by that, but just the knowledge of being a profitable trader. There's, as you know, thousands and thousands of ways to be a profitable trader. And the entry is the smallest part of a trade. And what really got me over that hump was position management, is having solid position management. And I found that through the use of options. I found out that as I got a little bit more seasoned, I could be disciplined 9 out of 10 times. And 9 times out of 9, I was perfect. And then 1 out of 10 times, I would just mess it up. So I got into options and I realized, hey, with an option, I can position size for max loss, where I literally can't lose more than whatever it is I have determined. That right there made it to where I didn't have to fight the battle 9 out of 10 times doing it right and then losing it. I automatically made it to where I literally couldn't lose any more than just my, 0.5% of risk or 1% of risk or whatever I set it at. That really helped get me over the hump because, as we all know, trading mistakes are pretty much what kill young traders. And it's all on the position management. It's not on the entry. It's on the exit.
And so it sounds like you at an early stage, you got into trading aspects that many traders sometimes take years to learn. Was that a result of being around other traders that really helped ramp up your education?
Absolutely. And one of the first stories I remember hearing from one of the guys at Maverick Trading is he told a story about there was 2 guys, and again, it was all like second and third hand stories that you heard back then before the internet. And the story was that there was 2 traders, and they had a premise that it didn't even matter how you pick stocks. And to prove this, they hung up the Wall Street Journal pages on a wall and threw darts. And whatever stock the dart hit, they flipped a coin, heads they went long, tails they went short. And their premise was, it doesn't matter how you choose them, all that matters is how you manage them. Basically, selling losers and holding winners. And the story went that they did this for 18 months straight, picked 10 new stocks every month, and they never had a losing month. Wow. I have scoured the internet for this information. I have gone everywhere, and I've even asked in public forums, and I think it was part of the Turtle Traders system, if you've ever heard of the Turtle Traders.
Yeah.
But it only exists as a story. Mm-hmm. The data does not exist. So that's actually why I started what is called the Flat Earth Trading Society, is because I wanted to have this data to prove to the world that it doesn't really matter how you pick them. It's all about the management.
Well, that is a good segue. I watched many of your videos on YouTube on the Flat Earth Trading Experiment. It's kind of a funny name. What was the catalyst for choosing that name? It's quite amusing.
Oh boy, it was fun. I wanted to do something that, was conspiratorial, or something like, catchy. In retrospect, I actually hurt myself because all of the videos on YouTube are labeled with a disinformation warning that the earth is not flat, that the earth is actually round. And so I probably got punished by the algorithm, but not a big deal. But I wanted to basically say, hey, that the thing that you've been led to believe, that the entry is so important, because if you go out there and you look at all the books, all the magazines, all the websites, 99% of it is about the entry. It's all about the entry. Oh, getting in at the right candlestick, getting in at the right moment. And there's very little about the exit. And the exit is where the money's made. And we've all heard that. Even new traders know that's true. But yet 99% of the information out there is all about the entry.
Why do you think that is? Is it just sexier to talk about the entry?
Yes, it's absolutely sexier to talk about the entry. And if you think about, stories you tell about, when you got in, you never brag about really when you got out. It was always like, oh, I got it at the perfect moment, or I got in at the right thing here. Very rarely do people ever talk about the exits. The entries are just much sexier.
So you created this experiment, and then what were the rules for this experiment?
So I determined we were going to do 100 trades. And in the initial video, I talked about why I believe this was going to work. And the whole premise is, and we talk about this with our traders at Maverick Trading all the time, is that you're going to make 10 trades. So let's just say that any trader out there, they're going to make their next 10 trades. And they're going to do their research. They're going to look at their charts. If they do fundamentals, they do fundamentals. The only trades they're really going to make are the ones that they think are actually the best. Those are the only trades you end up making. Here's the irony. Even though you tried as hard as you could, you got into the charts as much as you could, here's the irony. 4 out of 10 are going to be losers right off the bat. 4 out of 10. You did everything perfect. Did it all right.
Yeah, why is that? I mean, why 4 out of 10 would be losers?
Look, I'm just throwing out a number.
Okay.
So let's say you had a 60% win rate in your trading.
Mm-hmm. Mm-hmm.
That means that 40% of those ones you thought were great were actually terrible. The only reason you made them because you thought they were good. So I'm just throwing a number out there. And then out of, let's say 3 or 4 of them, they're going to be okay winners. They're going to be okay, not fantastic, but okay. And then in that group, you're going to have only 1 or 2 of those trades are going to take off and either run if you're long, go down if you're short. Only 1 or 2 out of 10. And actually, if you take a look at the worst ones, you will likely have 1 or 2 that turn into real serious losers. Now, remember, you took all these trades because you had all the lights, you had all the green lights, you had all the everything. And I talked about how this is trading. You need to understand that whatever system you use, you're going to get a bell curve distribution of results, period. It's always going to be a bell curve. Most of the trades you make are going to be somewhere like pretty good, pretty bad, somewhere in that middle. And then you're going to have your next ones that are, these ones were really good or really bad. And then out of 100 trades, you're going to have, that's not an option. You do pick them. So the premise was, hey, if we simply cut off the left side of that bell curve with and again, we used a 2x ATR trailing stop. It was a pretty simple strategy. I wanted it to be simple. I've had people reach out and say, Rob, is that the strategy? I'm like, no, there's much better ways to do this. But it was a simple 2 ATR trailing stop. So for people that aren't familiar with average true range, it actually measures the average volatility of a stock. So a more volatile stock gets a wider stop, and a less volatile stock gets a narrower stop. So it's just dynamic on the volatility of the underlying. And then our rule was that, again, we put in the 2x ATR stop. So if it goes against us, as soon as it hits 2x ATR, it's gone. And we did 1% risk, 1% risk on every single trade. And then the rule was if we did get to a 2x ATR profit, then we'd use a dynamic system and we'd move up to 1.5x ATR. So just snugging up that gain a little bit, or that stop, to make sure we have a gain. And if we got to 4x ATR, we then moved to a 1x ATR stop, and that was it. So we ran this over 100 trades. I started this experiment on August 1st, 2023, and we finished it somewhere around July 20th of 2024. So it took almost an entire year to go through this.
Did you expect that it was going to take this long, or was that your expectation from the beginning?
I really didn't have an expectation of how long it's going to be, because I was just making these trades when I had free time. Whenever I had some free time, I'm like, hey, I got time to do one of these. Because unlike just making a trade, you have to go live, make a video, do editing, do all the stuff. So it was a probably 30 to 45 minute process to actually make a trade, make a video on it, and produce it and upload it. So it ended up being about 3 to 4 trades per week, and we were trading off of the daily chart. So these trades weren't, super quick trades. They typically lasted, I actually don't have the data for that. I got a lot of data for you, but I don't have the data for the average holding period. My guess would be the average holding period was around 12 days.
And that's because of where you put your stops, or where your system that you followed. You would either raise a stop or you get stopped out early, and so that was just as a natural. It just happened naturally.
Correct.
How long you're...
Yeah, and if let's say we used a 1x ATR stop, that would have definitely shortened the length of a trade. And if we made it wider, we'd be in things for longer, for sure.
Well, how did you get a chance to pick the stocks? I mean, what was your method?
Well, I used a lot of methods, and I wanted to have fun with this. I wanted this to be a fun experience. So we did some Scrabble tiles. So I bought some Scrabble tiles and dumped them out on my desk and filmed it. And I just flipped them over at random, and whatever ticker symbol they made, then that was the stock that we picked. And then what we did have a trend following rule, because we're big trend following adherents at Maverick Trading. All of the data, all of the research shows that there is an edge in following the trend. Our basis, or our decision of long or short, was based on the slope of a 13-period estimated moving average. So just whatever the slope of the EMA was at the moment, we went either long or short based on that. We used lots of other fun things. I even bought a Ouija board. My wife was not happy about that. She's like, you can't have that in the house. So I had to leave it out in the garage when I wasn't using it to pick trades. And it was dumb. I closed my eyes and I ran my hands over, and whatever letters it hit, those were the letters. And then we made a ticker symbol out of it. I do a lot of travel. So I traveled over to Europe for about a month or two during the experiment. So when I was in Spain, we chose some stocks headquartered in Spain. When I was in Germany, we did some stuff with Germany and some ETFs. So had a lot of fun. I tried to keep it pretty interesting. Lots of some sports stuff as well. We did some March Madness picks, based on the teams and where they were headquartered. I tried to make it as random as possible, just to show that, hey, you know what, there is no cherry picking here. It's truly random.
Did you use the 13-day EMA because you've used it in the past with good results?
Yes. Okay. But again, that 13 was selected for the 2x ATR. You got to make sure you're matching up all your indicators with your position management. You can't use really short-term things to get into a position, then have a very loose stop. I mean, you could. Look, if it tests out and you back test it and test out, and it tests out well in demo trading, sure, you could use it. But typically, you want everything to match up as close as possible.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
And what's the chance using a 2 ATR stop? What is the chance of getting stopped out, say, within a certain period of time?
Well, look, we actually didn't even discuss this beforehand, but if you watch the first video, we talk about there's around a 33% chance that it's stopped out within the first 5 days. And the way we measure this is through the options market. So if you pull up some options chains and you run some analysis, it tells you, hey, this is the odds of a stop out in the first 5 days. So we knew right out of the gate that roughly a third of our trades we made would be stopped out in the first 5 days. We just knew that based on statistics.
When do you move up the stops again?
So the rule was if we got to a 2x ATR profit. So for example, there's a $100 stock that has a 2 ATR. That means the trailing stop would start out at $4 of a trailing stop, which is at 96. And then for those of you that don't know what a trailing stop is, it moves with the stock. So if the stock goes up a dollar, the stop moves up a dollar. If we would get to 104, which would be the 2x ATR target, we would then move our trailing stop to 1.5x ATR, just snugging it up a bit. At 4x ATR, we'd snug it up a little bit more to 1x, and then that's it. And then nothing was done after that.
Did you ever get any stocks that continue to run, even with such a tight stop?
Yes, and it was actually our biggest win. It was when I was traveling down in New Zealand, and I was at this just amazing waterfall. And for any of you who've been to New Zealand and any Kiwis out there, I can't wait to come back to your country. It's amazing. It's covered with water everywhere. So I'm like, hey, let's do something with water. So there are a few water ETFs. ETFs are just bundle together some stocks that have to do with water. And that was our largest and longest winner. So we made, I think it was like 7.5x ATR on that one. And I want to say we got into that one end of January and didn't get stopped out until like mid to late March. So that was like probably 45 days of length that it just continued to move without a big enough pullback to knock it out.
Wow. Yeah, that is quite a long time.
But out of 100 trades, that's guaranteed to happen. I mean, out of 100 trades, if you let your trades run that are going to run, you will get 1 or 2 out of 100 that are going to do that.
So that's just a statistical fact or figure that you're just going on the laws of statistics that eventually you don't know when you're going to hit that big gainer, correct?
Correct. But we also need to admit that we're also going to pick a stock that goes against us like that just goes against us and over and over again, every day going down without any sort of meaningful bounce. That's why we have the trailing stop in there to cut those off and limit them to a 1% loss.
Wow. One of your videos, you said, trading is trading. It doesn't matter what you trade. So just curious, how is this? Are all markets the same?
No, all markets are not the same. But all trades, it's a ticker symbol and a price. That's it. And that the ticker symbol, whatever it is, the underlying, is going to go up or down based on supply and demand, period. So that's what I mean by trading is trading. It's universal. If you're trading gold, if you're trading bond futures, if you're trading Forex, everything you're trading is a symbol that has a market price that goes up and down based on supply and demand. Now, there's lots of little rules you got to learn for different markets, a lot of leverage rules or margin rules, and every market is going to have different levels of volatility. Some markets are going to be much more volatile. But in the end, I use the example of that driving is driving. You could drive a go-kart, you could drive a steamroller, or you could drive an F1 car. In the end, the mechanics are pretty much the same. They all work the same, but some go faster than others and some are more dangerous. And there's little things you have to learn. But that's what I love about trading. It is universal. Once you really get it down, you should be able to trade every single market out there.
I noticed that after you've done 59 trades through the system, notice that your account was near break even. And so I'm just curious, after so many trades, one might think that this experiment is a waste of time.
Yeah. And at trade number 59, I was thinking that myself. As you can see, look, when I did this, I said, look, this could fail terribly. If we just got a bad batch of statistics where, hey, something happened and just it didn't match up to the market at a certain period of time, I knew that at the end of 100, there was a possibility that it could be at a loss. Like, I fully knew that and understood that. And at trade 59, I said, oh, we'll see where this goes. We'll see where it goes. But look, that's trading. That's trading.
Mm-hmm.
You just slug it out day after day after day after day, have more winners than losers, win bigger than you lose, do it over a long period of time, and you're going to be really successful.
So tell us about the losing streaks. What happened with there? I imagine you probably had a losing streak somewhere along the way.
Yeah, we did have a losing streak. And just, we haven't yet talked about total return. Let's just get that out of the way. So the account was up like 15%. So we started out with a $100,000 account, and it ended up right at 115,000. So, overall, there was a return on it. Did it beat the S&P 500 during that time? It did not. It did not. And I've even had some people say, oh, this experiment was dumb. It didn't even beat the S&P 500. I'm like, look, that was not the point of it. I was using a Ouija board, for goodness sakes. Like with good entries, you can add on that. And that was the point of the whole experiment. If you have your position management down and it's really good, you should be profitable. I don't want to say right away, because that's giving people too much false hope. There's a lot of work to do, but you're at least starting in a very good situation as a trader, to where then your entries really start to matter. So let's talk about the streaks, because this was the most interesting part of the entire experiment. And I've been trading now for 27 years, and it still surprised me. Like, oh my gosh, this is amazing. So our best streak, we had 3 streaks that were the same. The most we had was a 5-win streak in a row, but we had that 3 separate times. The largest streak we had was from December 11th to December 20th. And that was a gain of $8,600 or 8.9%. So we had this really big gain right in early December. Now, interesting, when do you think our longest or worst loss was?
Probably right before or afterwards?
Right after.
Interesting.
And so again, this is just totally randomized trading. This is picking stocks out of a hat.
Mm-hmm.
But just like in real life trading, you have streaks. And one of the things we talk with our traders is we give them charts that show, like, if you flipped a coin 100 times, what are the odds that you would have 7 losers in a row? I actually do know the odds. It's about 42% of the time.
Well, really? 42% of the time, you would have 7, you would flip the coin and you'd have like 7 tails in a row.
7 tails in a row or 7 heads in a row.
Really?
So statistically speaking, you're highly likely, very highly likely, to have 7 winners or 7 losers in a row. That's just statistics. Well, what happens in trading is once we have these streaks, we either start to think we are the dumbest people in the world, or what is my Achilles heel in trading and really hurt me in my first probably 5 years in trading was after I had the winning streaks, I started to think I was really smart. And I'd say, Rob, man, you got this. You did it. You found the Holy Grail. You did it. And you get, lots of confidence. And for me, I'm a big extrovert. So when I get like excited, I want more. I want more. So I want more gains. I want more trades. I want more position sizing. I want more of everything. So what happens is, of course, that leads to a really big drawdown. That is all psychological problems that we bring on ourselves as traders. But this is just purely statistics. So we had our worst drawdown was from December 20th to January 24th. And that was 10 out of 11 losses. And the one in there that wasn't a loss was a break even. So let's just call it 11 losses in a row. So right after we had that big run, we had the longest and largest pullback of the entire experiment. Now, again, as traders, this is exactly what happens. And we get into psychology of what's going on in our minds. We have the big runs, we start thinking we're smart, and we get aggressive. And then we have these big pullbacks, and then we start thinking we're not good. And then we talk about things like, well, maybe I shouldn't take the next trade my system gives me. Maybe I should, just sit out for a week or two. When do you think we got our largest gain of the entire experiment?
Maybe after a long losing streak?
Yep.
Interesting.
That stock I picked in New Zealand was the largest gain, and that came after an 11 loss streak. So if you would have chickened out, if you would have backed away, if you would have deviated from your system, you miss those moments. And the whole point of this experiment, and this has kind of been the tagline at the end, is that consistency beats intelligence every single time in trading. If you want to be good at trading, stop thinking you're so smart. You're not smarter than the market. Start thinking about, how do I consistently enact a system that has an edge in the market? And that's what this whole experiment was about, is just to show people what an absolutely robotic system can do for you if you don't deviate from the rules.
So in this experiment, did you use any top-down or sector analysis to manage your positions?
None.
Interesting. Wow.
Well, again, but that was the point. Now, in real trading, you should absolutely do that. But remember, I wanted this to be as close to 50-50 randomized as possible. So no, we didn't use anything like that. This was purely just 2x ATR.
I'd like to go back to when you said that after you had a long winning streak in your earlier years, that you would get overconfident, and then that would end up leading to losses afterwards. And I'm just curious, what about the different quality type of setups and increasing position sizing based on the quality of the setups?
Great question. I think there's a couple questions in there. Let me first tackle the first part of my Achilles heel of getting overconfident. It's something that really just got me. It really took me probably about 7 or 8 years to really do it. And the last major mistake I made on this was 2008. And I still remember, and I got to tell the story just to help everyone out to where they don't do this. During the collapse in 2008, I love pyramiding in Forex. That's one of my favorite strategies, is to pyramid. Now, pyramid is you take a position and then you add on to the position if you have a gain. And if you have more of a gain, you add on more of a position. Now, it only works when there's major moves, but I pyramided into 44 lots of Aussie yen short. And the market dropped, everything fell away, the yen was spiking. And I remember that trade was my biggest trade up to date of like $185,000. And it was like awesome. I'd been building this trade for a couple of weeks, adding on. And then again, all the banks started collapsing, and it was just a great gain for me. And I remember just being on top of the world. And I even told myself, Rob, this is where you're dangerous. So why don't you just not trade for a week? why don't you just not trade for a week? Well, I didn't have the discipline to do it yet. So my next trade, and remember, I said as an extrovert, my next trades need to be bigger and better and more. I started with 100 lot position in a Forex trade. That is a giant trade. And I remember when I hit the button, my P&L showed negative 3,500 just from the spread.
Oh my God.
And I remember when I saw that, I thought, uh-oh. But again, I didn't want to take that loss, and it went against me, and I closed it out finally and gave back about half of what I had made, building that trade over weeks and weeks of very meticulous, methodical trading. That's something that I have really struggled with. Now I'm so happy to say that I haven't made that mistake in, 15, 16 years now. And I don't have any compulsion anymore. And that's what's really nice when you trade long enough to where you don't even have the compulsion to mess it up. All right. So that's the first part of your question. The second part was about a dynamic position sizing system. I love it. I absolutely love it. I'm a big fan of basically having a system where you take larger positions when you have better odds in your favor. And we teach this to all of our traders in Maverick Trading, and I give a poker analogy. Now, do you play any poker?
No.
Okay. Well, poker works just like trading. You get a couple books, you learn about the odds of the hands, and all of a sudden you go to Vegas or something, and you think you're pretty good.